Hello. Hello.
Hello.
Yeah. Am I audible?
Yes, sir.
Yes, sir. Yes, sir. You're audible.
I think I know what happened. Participants had okay. I think the meeting was ended in between. Huh?
Yes, yes. It got.
So we were discussing. I think basic option positions. So let us put it this way. Before we start, let us take this on a couple of outlooks so that you can identify which would be the correct option position that you would look you would want to take up. So let us say a person is bullish and ready to take downside risk. Which would be the better position for him? A person is bullish on an underlying and he is ready to take the downside risk. So which would
long call.
No, he's ready to take the downside risk.
Okay, ready to take the downside risk and bullish on the market.
So yeah, again with call you can say, but at the beginner's level, when you are bullish on underlying and he is ready to take the downside risk, you can go for long futures.
Long futures.
He can go for long futures. Basically because he is bullish and long futures. As the underlying asset goes upward, definitely he would what is it? He's open to the profit, but then he's ready to take the downside risk, which means he's very confident that the underlying is bullish and it's not going to come down. So rather than going for a long call, it would be long futures will be better, because for a long call there is a cost of premium. Are you getting it? Long call is also okay, but then long call you have to pay a cost of premium. So why are we paying the cost of premium? Because we want to contain the downside risk. So I am ready to take the downside risk means I am very confident that I am bullish and it's not going to come down. Okay, so Nifty is trading at 17,400 now. I believe that Nifty is still going to be bullish and there is no signals of a correction. So probably you would go for a long futures. Okay, now the same thing. Let us take the current Nifty situation. But he is worried about the downside risk. Then what will you advise him? Worried about the downside risk. Then which will be the position that is appropriate for him?
Long call.
It will be long call. So what does a long call give you? It gives you the right to buy the underlying asset at the strike price without any obligation. This is what happens with the long call. Now, is this okay? Yeah. This is okay.
Yes.
And what about a long futures? Has the right and obligation to buy the underlying asset at the strike. And what would be other factors? Other factors that will be in your mind? No premium. Not. Here you have to pay. What is it? This is not. This is outlook. Okay. This is the position. And this is the description of the position. Is it not? Fine. The group, everybody is finding it difficult to join. I think no messages. It is 77. Okay. So So this is the what is it? Basic thing. Now, if you're bearish, what will you do? If you're bearish, what will you do?
The long put and
Yeah, tell me.
Sir,
long
Excel
put.
sheet is not.
Okay. So if you are outlook is bearish, and uh, ready to take the upside risk. So I believe that now the market is already very up. Now the market is already very up. So from tomorrow or from today onwards, the market is going to fall down. I'm willing to take, if it goes against me, if it is going the upside, I'm willing to take the risk. So what does that imply? When a person say I'm ready to take the upside risk, it simply means that
Short
I'm
futures.
very confident that the market is going to break down, and it is very unlikely that it will go up. Okay, so what position can we suggest?
Short futures.
Short futures. Short futures means those who are beginners. Short or long simply means that long means I'm increasing my position. I am buying. Short means I'm selling a particular asset or underlying. Okay, so you can just use a short for sell and then a long for buy. So don't get worried about these terminologies. So your bearish will go short position. So how do you describe? This has the right and obligation to sell the underlying asset at the strike price. Okay, so I'll also let me give an illustrative example. Yes, example. Okay, now see, let us say Nifty is now 17,400. Okay, or exactly at this point of time, what is Nifty? Should be okay, 17,455. So let us take it as 17,000. Okay, let us take the 17,450. The Nifty, so my outlook is bullish. So I believe that by September 30th or in 1 week, I will see Nifty at 17,800. Okay, so I am bullish. Okay, I am bullish on this. So what would be the your position? How do you take it? So how do you illustrate with this example? Yeah.
Buy the Nifty futures for the next week.
Yeah, you buy the Nifty. Let us say if you buy a futures with a strike price of let us say 17,500. So what do you do? This is example. What do you do? So you buy a Nifty with a strike price of 17,500. So what do you mean by that? I am buying a Nifty with a strike price of 17,500? What do you mean by you are buying Nifty with a strike price of 17,500?
That on the next week's expiry, the Nifty will be more than 17,500.
No, that is not the thing. When I say that, you are bullish on Nifty, which means you are expecting Nifty to be 17,800 in next 1 week. Today, right now, Nifty is trading at 17,450. So to make the profit out of your prediction, so what you are doing is you are going to your broker and you are buying one Nifty at the rate of 17 Nifty futures. You are buying a Nifty futures at the rate of 17,500. So when you buy Nifty futures at the rate of 17,500, what is the implication?
The investor is purely bullish, sir.
Yeah, buying Nifty futures at the rate of 17,500. So what is the implication? So now you look at column F. You are having the right and obligation to buy Nifty at the strike price. What is the strike price? 17,500. Is it not? So what will be the repercussions? In 1 week, if Nifty goes to, when will you make profit?
More than 17,500.
Yeah, if Nifty goes above 17,500, definitely even at 17,501 rupees, you will start making profit. 17,600, you will make 100 rupees profit. 17,800, you will make 300 rupees profit. Is it not? But on the other hand, if the market goes against you, suppose your prediction was 17,800, but however Nifty falls down to 17,200, what will happen?
Sorry, I am in the losing.
Risk
Yeah.
Risk
You will start losing. For example, you take this one. Yeah, you take one more chart. So I put 7. So what is my this thing? 17,400 now. So your strike price is 17,500. You can take any strike price. For this explanation, I just took 17,000. So let's say 17,100, 17,200, 17,300. Okay, so now if I just drag it down. So now tell me what will be your profit? What will be your profit? So here what will be your payoff? This will be this minus
400.
this.
Yes.
Is it not?
400
So here
minus.
you will make a loss,
400.
and as Nifty crosses above
17,500.
just one second. I have to use this cell. That's right. Okay. Okay. So as you could see, there's a formula F5 minus G2 minus G2. Yeah. So you can see exactly at 17,500. If Nifty happens to be in next 1 week, if Nifty spot happens to be 17,500, you will finally come out with a no profit, no loss situation. But as Nifty goes above 17,500, you will start making profit. Or if Nifty falls down below 17,500, you will start making losses. So that is what I was trying to explain here. If you are purely bullish and you are able to, you are willing to take the downside risk. That is, if suppose your prediction is on this side, that is Nifty is going to raise. But if it happens that Nifty turns against you, and you are willing to take the downside risk, you will go for a long futures. The implication is that you will have the right and obligation to buy it. So if Nifty goes above the strike price, you will be in a happy mood, you will make a profit, but otherwise you will make a. Is that clear?
Yes, sir.
Sir,
So now,
as like in options, there are in the money, at the money, and out of the money. The same is happens in the futures also.
Matlab, sir?
I think it
Sir,
may happen in options.
sir, the strike price below the current spot price are in the money. In futures also.
You can take different strike prices. The strike prices, as we have in the next session, we'll look at different strike prices. At this point of time, I'm not introducing that because for some people it will be confusing. Yes, you can take any strike prices.
Sir, the terminology will be same in the money, at the money, and out of the money.
What is it, sir?
Sir, the terminology used in the futures will be the same for as like in the options.
I'm not getting a question.
Sir, actually,
Actually,
sorry to interrupt, sir. In the money, out of the money, or at the money.
Options,
are the
options.
That is
which are
in the option segment.
Sir, yes, they are largely used in option segment, but they are only the indication whether you are getting a
Yeah,
profit.
that is the current outlook or the current work of that can actually turn out as the period progresses.
Right.
That is
Margin
the
money
options.
concept.
In futures, you are taking a strike price, and there is no choice to exercise or not to exercise. So futures, how do you take a futures? When Nifty is trading at 17,500, you will have a target, and accordingly you will trust strike price. We'll discuss that with the market data. Yeah, please keep in mind. We'll discuss that. You can just ask me later. I'll come back to that. Now, when you have a bullish this thing, but you are not willing to take a downside risk, we said you will go for a long call. So what is the implication against the long futures? You have to pay a premium for that. Huh? So what would be the example here? So if Nifty is 750 and you expect your Nifty to go to 17,800, so you are buying a Nifty call, Nifty call with a strike price of 17,800. So now what will be the replication? Now what will be the replication? And let us say you paid a premium of 30 rupees. Paid a premium of 30 rupees. Usually call premium is denoted by C, small c. So the premium of 30 rupees is paid. So now quickly tell me what will be the revised payoff here? Will you have 400 rupees loss here? Will you have 400 rupees loss? You will not have a 400 rupees loss. What is the reason?
No, sir. No, sir.
See,
30.
you only
30.
have the right to buy it. You
30.
don't have the obligation to
30
buy it at the
loss.
strike price. So if it is a futures, you have the right and obligation to buy it at the strike price 17,500. So if Nifty falls to 17,100, you will still have to buy it at 17,500 and that will cost you a loss of 400 as in the case of a futures. But when you come into an options, you don't have the obligation to buy it. See, you only have the right to buy it. Therefore, you will not make a loss of 400 rupees. How much will be your maximum loss?
Premium.
It is a premium that you have already paid. The loss is limited to premium. Here also, the loss is limited to the premium. Here also, the loss is limited to the premium. Here also, the loss is limited to the premium. Here also, the premium that is given is gone. Here, will you make 100 rupees profit? In
No.
futures, you can make 100 rupees profit.
No.
Here, you have
100 minus premium.
Because 30 rupees, you have paid out as premium. Here, the profit will be
200 minus
170.
premium.
Here, it will be 270. Is it not? So, and here it will be 370 like that. Is it not? So this is the implication when you take a call instead of a long futures. I hope that is clear. Is it not? So when do you take this? You are paying a premium of 30 rupees. So you are sacrificing a possible profit to the extent of 30 rupees, but you want to take a downside protection. How much ever Nifty falls, you want your loss to be limited to the premium or limited to 30 rupees. So if you have that particular outlook, you are a person who should go and take a call option. Fine. Now, next possibility is bearish and ready to take upside risk. What will you do? You will short futures. You will sell futures. Is it not? And when you sell futures, what futures there is no premium obviously. Is it not? But what is the description? When you sell futures, you have the right to sell and also obligation to sell. So let us put it this way. So in 1 week, you expect Nifty to stay at 16,800. So that's why you said you are very bearish in the market. You are bearish now. It is trading at 17,450. Good. Now next week your prediction is Nifty is going to correct and come down to 17,800. So what will you do? You are ready to take the upside risk. What do you mean you are ready to take the upside risk? Right now, Nifty is trading somewhere here. You are expecting that the Nifty will come down to a lower level. So what will be your profit? This is long futures. So what will be your profit for short futures? What will be your profit here? Will you make a profit? Somebody is new to this. Can you try to answer? Will you make a profit? The 50 falls to 17,100.
400.
Sir, 400
Definitely you will
profit.
make a profit. Why are you making a profit? Because you are selling a future. Sorry, you're short futures. You're selling a futures. You're having the right and obligation to sell the underlying asset at the strike price 17,500. So when the market falls down to 17,100, you still have the right to sell Nifty at 17,500, which makes you a profit of 400.
400.
Here you will make a profit of 300.
300.
Here you will make a profit of 100. Here there is no profit or loss. Yeah. And here what happened? You will make a loss of 100. Why are you making a loss of 100? Here you will make a loss of 200. Okay? Why are you making a loss of 200, etc. here? Because you have the right and the obligation to sell it. Do not. So if the market goes against your prediction, you predicted the market is going to come down, but the market, actually goes up. So still you have the right to sell it at
Sir, why we are
and also
losing 100 rupees
Huh?
at why we are losing 100 rupees at market price?
Sorry, that is not 100 rupees. This is 0. It is 100 is here. Now it is correct. Now
Yes, sir.
No. Yes.
correct. Now
100, 200, it will be 100.
Yeah.
200.
So here you are also having the obligation to sell it at 17,500. That is a promise. That's a commitment. Whatever happens, you have to sell it at 17,500. So when the market is 17,800, you have the obligation to sell it at 17,500. Then what is your notional loss? 300 rupees.
So above 0, there should be 100 rupees of profit.
Yes,
So somewhere this is
100 next 200.
okay.
100 and 200.
I think I have
This is
gone
100 and
one
this is
row
200.
down. 300. This is
Yes, sir.
Is it?
Yes, sir.
this is
This is
400.
100, next one is 200.
This is 200. Yeah. Sorry, I gone one row. I missed one. Now it is correct. Yeah.
Right.
Yeah. So this is what will happen. Is it not? This long call. Yeah. Is that okay?
Yes.
Yes, sir.
Yeah. So it's easy if you just put it as a formula. So what is it? This minus. Sorry. No. This minus. Just raise this and drag it down. Okay. So this is what a long futures will. Sorry, short futures will. Okay. Now, so we discussed bullish. You're bearish, but you don't want to take upside risk. What will happen?
Short call.
Sir, to pay premium.
Yeah, you can take. What can you take? You can go for long.
Good.
Okay, you can go for a long put. Somebody was saying short call. Short call is also adaptable, but then there is a slight difference between that. I'll just discuss now. So what is a long put? The right to sell without
Sell.
any
Obligation to buy.
obligation to sell. The right to sell what? Sell the underlying asset, whatever underlying asset at the right. So you have to pay premium. Is it not? You have to pay premium. See, in long cases, always you have to pay the premium. Which whenever you are taking long any option, you have to pay the. So now tell me again, Nifty is so much. So how do you narrate the situation? Nifty is let us say 14,750. You expect that the Nifty will come down to 16,800. So can you tell me how do you go about it? And let us say what is it? You're buying Nifty at okay. Let me copy this. So what will you do? You are buying. So you are buying Nifty put. Now you are buying Nifty put with a strike price of okay 17,300, and you are paying a premium of let us say 40. Now tell me what will be the repercussion? What will be the payoff? What will be the payoff? Okay, I'll take this slide. So what will be the payoff?
For
For
Sir,
what
40,
is it?
sir.
A long put. Long put.
okay, long. So 400
Before
minus
we
premium.
work out the payoff, so long put gives you what? Right to sell.
Yes.
Not at rate of 17,500. So if Nifty falls down to 17,100, will you make a profit?
Yes.
How much profit?
400 minus premium.
You would make a profit of 400, but remember, in short futures, you will make a profit of 400, but here you are paying a premium. How much is the premium paid? 40 rupees now. So you'll make a profit of 360. Here you will make a profit of
360.
260 rupees.
260.
Here you will make a profit of
160.
160 rupees. Here you will make a profit of
60.
60 rupees. Here,
Here,
Zero, sir.
you have
Premium.
a
Premium.
right to buy,
Loss.
sell it at 17,500, but the market is also 17,500. You will not take any profit.
Sir,
unless
minus
coming up
60,
that
sir. Minus
You already lose the premium, minus 60. Is it not? That 60
Sir,
is
minus 40, no? Premium. Premium
40.
40.
Minus 40.
Okay,
minus
okay,
40,
fine.
sir.
Minus
Okay,
40.
okay.
Minus 40.
40, 40. Okay, correct. 40. And what about here?
40 plus 40. So 60, sorry, plus 60.
No.
60.
You will
So
make a
minus-
loss. Your gross loss
minus
is 100
60.
rupees.
Minus 100. Yeah. Okay.
Your
100 plus
loss
40,
is
140.
but however, you don't have the obligation to sell it. Nifty, no, you had the right to sell Nifty at 17,500. But
we
the
will lose
Nifty is
only premium.
17,600. So will you sell it? See, suppose you are having one Nifty in your hand. Assume that is a physical
It is limited to 40
tangible asset.
only,
Just
sir.
assume.
Yeah, we will
You
lose
have one
only
Nifty in
premium.
your hand, 17,500. You can sell it in one market for 17,500 and another market for 17,600. Which market will you sell it?
Yes, we will have loss of only premium. We will not.
Yeah, you have the right to sell it for 17,500, but the market price is already 17,600. You will say that
we
I don't have the
any
obligation to
obligation.
sell it to you.
Limited to only 40.
I leave it unexercised. So
Yeah,
your
we
loss will
don't have
be
any obligation.
premium. Are you getting it?
Yeah.
Now if the Nifty is 17,700,
Again, same.
if it is a
Sir,
future,
again-
you have the obligation to sell it at 17,500. So though the market price is 17,700, you still have the obligation to sell it for 17,500. You will make a loss of 200. But when you come to long put, you only have the right to sell it. You don't have the obligation to sell it. So you are saying you will maximum lose your premium. You will maximum lose your premium. You will maximum lose your premium. Like that. Is it? Are you getting
Yes,
it?
Yes, sir.
So this is how long put will go. Okay. Now, okay, we have taken bullish and bearish. Okay. Now the next question is, we discussed long call. So my question is, who will be short call? Who will be short call? Suppose you go for a long call, there must be somebody who is
Yes.
willing to take a
Short call.
short call. So who will be the ideal person for your counterparty short call? Will he have a so short call?
He's
Will he have a bullish or a bearish perspective?
His objective is purely opposite to us.
Bearish.
Yeah, he is bearish because long call. What are you preparing? The long call, you are acquiring the right to buy the underlying asset. So when you procure the right to buy the underlying asset, then you believe that that asset will actually go high in the market. So you are buying Nifty at 17,450, assuming that Nifty will go to 17,800 in next 1 week. So a short call definitely should not have a bullish perspective. So let us at this point of time, let us say short call is having a bearish perspective. Now the question is, if you are having a bearish perspective, should you go for a short call or should you go for a long put? Long put is also having a bearish perspective. Is it not? What is the outlook for a long put? See, bearish and not ready to take the upside. So he is bearish. So
Yes.
when you are bearish, you are in a dilemma as to whether you should go for a long put or whether you should go for a short call.
Sir,
Go
if
for long
So
put, sir.
if a person is expected the market either will go downside or will remain at the same position,
Yeah.
then he will short call.
Yeah.
And if we expect that only downside, then long put.
Correct. So what sir is saying is, if you are very clearly bearish, it is better to go for a long put. See, look at here. If you are bearish, where is long put? See, you are bearish. The market is falling from 7,500 to 400 to 300 to 200 to 100. You can see the profit is also increasing from 60 to 160 to 260 to 360. So definitely, if you are bearish, it is better you go for a long. So when you will go for a short call, when you are
Profit is
mildly
quicker.
mildly bearish, or rather believe that the market will stay very close to the sides. Can you make sense out of it? So you have different persons will have different outlook. So now you ask me, I'll say that Nifty, though it is climbing up every day, it does not seriously show any indication of correction. So but for the last 3 days, if you look at Nifty, last 1 week you could see 100 points, 200 points, 300 points, hike in Nifty every day. But last 1 week, Nifty is not moving. It is yesterday it was only 15 points. Day before yesterday it was only. Yeah, day before yesterday it was only 20 points. So this week, Nifty is by and large stationary, where it is it's not actually moving up or down. It is going to be by and large the same place. So if I believe that Nifty is going to be like that, it is not going to go up. It is mildly bearish, but however, I believe that somewhere near the strike price it will be. It is not going to fall. It is going to be where it is. If that is your situation, you can actually go for a short. Say now you just look at this payoff. Let us say short call. So let us say what will be your payoff if it is a short call. What is the premium for the short call? Premium was 30 rupees. Now premium was 30 rupees. So what will be your listing here? Short call means what? What is your right in short call? What is your right in short call? What is your right in short call? What is your right in long call?
In short call, we are right to sell.
You absolutely do not have any right. Any short position, you don't have any right. That's why I said yesterday also, short position is always unprivileged. It is for that unprivileged position that I am willing to take, I am compensated with a premium. Short position, be it short call or short put, you always have the obligation to listen to the long put decision. Sorry, long positions decision. So, short call, the opposite position is, or the counter position is long call. So the long call has the right to buy it. So if he decides to buy it, you have to sell it to him. If he decides that I don't have the obligation, I don't want to buy it, short call has nothing to do. Simply keep the premium in the pocket and go back. Are you getting it? Are you getting it? Madam, once again, put yourself in the shoes of a long call. In long call, what is your right? In long
Right
call,
to buy.
Yeah?
Right to buy.
Right to buy. Do you have a right and do you have an obligation to buy? Do you have an obligation to buy?
Yes. Yes.
Long call?
In case of short call, we have to buy back.
No, sir. I'm talking about long call. Long call, what do you have in your hand? You have a right to buy and you don't have any obligation.
Don't have any. Yes.
So that is why you say it is an option. So I have the choice. I have the option to decide whether I want to buy it or not buy it at this time.
Yes.
Is it not? That is a layman's language. You have the right to buy it. In technically, we say you have the right without an obligation. Right without an obligation is what? It is a choice. It is an option. So you have the option to decide whether you want to buy it or not to buy it at this price. Is it clear?
Yes.
So in a long call, you have an option to decide whether to buy it or not to buy it. You can decide whether to buy it or not. So who is the counterparty to long call?
Short call.
Short call. So what is the status of the short call? Short call does, if both of them have the right, they cannot come into a contract. Only one person will have the right. So other person is obliged to listen to the long position. So the short call is obliged to abide to the decision of the long position. So who is powerful?
Long call.
Long position is always powerful. So why should somebody on the street call? I call him and say that, can you be the counterparty? He will ask, you are in the powerful seat. I have to listen to you. Why should I be a party to you? I'll say that, okay, don't worry. You keep this token amount premium. I'm compensating you. So when I am offering the premium, I will think, if I be the party to you, will any harm happen for me? So my outlook is, the market is going to be somewhere around where it is now. Now it is 74.50. So the market is not going to be bullish. It is not going to climb again high. It is already high. Either it will go down, or most likely it will be where it is. So therefore I sense that, okay, even if I join him as the party, there is no harm, because I believe that the market will not go. And simply I'll get the premium for 30 rupees as a free lunch in my pocket. So I get motivated and I happen to be the counter.
Yes.
Yeah. So what is your motivation? Your motivation is the 30 rupees premium that you get. And what is the confidence of taking that 30 rupees without any harm? You believe that the market is not going to go up. Okay. So when you take a short call, if the market falls to 17,100, what do you get?
30 premium
Will
only.
you get 400 rupees profit?
No.
No, because
Premium
the long
only.
call does not have the obligation to buy it at 7,500. He will say, I don't have the obligation, I don't want to buy it. So what you finally have in your hand is 30 rupees premium. Here also 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 30 rupees premium. Now what happens here? At
Here we will
17,600?
loss.
Remember, the long call will have the right to buy it at 17,500. So you have to buy it. Short call should therefore buy it from the market at 17,600 and give to the long call for 17,500. You will make a loss of 100, but you already received a premium of 30 rupees. So your loss would be
30 minus 100.
7.
Minus 70.
Here it will be minus 170.
30 minus 200. Minus 170.
And here it will be minus. This will go on like this. Got it?
Yes, sir.
Yeah. So if you are bearish, if you are strongly bearish, will you go for a short call or will you go for a long put? See, these two are bearish.
Acha. If we are strongly bearish, we will go for put.
If you are strongly bearish, it is better you go for a
put.
Long put.
Long put.
Long put. You have the right to sell it. So if the market falls to 17,100, your profit is 360. But here your profit is only 30 rupees. Got it?
Yes.
So, so short call is basically bearish only, but then he is not strongly bearish. He believes that he necessarily even need not be bearish. You only need to be having the outlook that no, the market is going to be lamed up. It is not going to go up, or it is going to be coming down. It is going to be where it is, something like that. So whatever premium is there, that will come here. Got it?
Yes, sir.
So we discussed long futures, we discussed short futures. So that is a naked position, which means it is directly proportional to the fluctuation in the market. You don't have a cap on the loss, you don't have a cap on the profit. Okay, so that is, and you don't have to pay the premium also, it is very cheap. Only the brokerage, whatever small amount you have to pay, that's no premium to be paid. So you are very confident, you are very aggressive, you don't want to take a protection, you can go for a futures or a long futures or a short futures according to your market outlook. If you want to take a protection, you are bullish, but you don't want to take the downside risk, you'll go for a long call. You are bearish, but you don't want to take the upside risk, you'll go for a long. Okay. And I was explaining you what is a short call. Now one more position is there. What is a short put? What is a short put?
Opposite to long put.
Rather, don't use the word opposite, because it typically don't have the meaning opposite. It is rather the counterparty to long.
Yes, someone
it is a
selling
counterparty to long.
Someone selling put option.
Yeah. somebody's selling. Yeah, it is a counterparty to put option. Yeah, where is long put is there? Long put is, yeah. So what? So this is short put now. Yeah. So where is long put? I'll write short put here. So short put is counterparty to long put. So what is the outlook of a long put? Look at this payoff and tell me what will be the outlook of a long put. Is it bullish or bearish?
Bearish.
Definitely bearish, no? Definitely bearish, because
Definitely.
as you can see, the market is falling down and down. You can see the profits are increasing. Definitely bearish, but he is also taking a protection by paying the premium. And in the event the market raises, unlike in a short futures, his loss will not be so severe. His loss will be always limited to the premium value. Okay, but now when you come to short put, for a long put, we all agree that he is having a what is it? When does the long call make a profit? Long call makes a profit when the market is going up. Is it not? When the market is going up, he is making a profit. So, okay, we'll discuss long call. We'll discuss short. Okay, we are discussing short put. Sorry. When the market is falling, the short put will make a profit. When the market raises, the short put will lose the premium. So, what will be the outlook of a short put here? As against long put?
Minus 360.
Like you had a long call, the short put is mildly bullish. Mildly bullish.
Mildly bullish.
Yeah,
And
mildly
rather
bullish.
believe that the market will remain close
mildly
to
bullish.
market price.
You can be mildly bullish and believe that the market will stay very close to K. Which means, let us now just try to work out the payoff for a short put. Will he make a profit here?
No, loss.
Yeah.
400 minus premium.
Yes. Why does he make a loss when the market is 1700? Think of the counterparty. Who is the counterparty for a short put?
Long put.
Long put is the counterparty. So long put has what in his hand? Long put has a right to sell the underlying asset at the strike price in his hand. What is the strike price? 17,500. What is the market price now? It is only 17,100. So easily he can exercise the right to sell it at 17,500. So the long put can buy it from the market price at 17,100 and exercise his right in the option to sell it at 17,500. He'll make a profit of 400, but the premium paid, his final profit will be 360. So he makes a profit here. What about the short put?
Minus 360.
It will be minus 360. Here it will be minus
260.
Here it will be minus
160.
160.
And here it would be minus 60.
60.
And here
60.
Plus 40.
it will be plus 40. Why is it plus 40?
Premium.
Because of 17,500, the market price and strike price is 17,500. So it is indifferent. If you exercise or not exercise, that is not going to be any matter. So the long put will get the premium in his pocket. What about here? Long put has a right to sell it at 17,500, but the market price is 17,600. Will he sell it to the contract for 17,500?
Long put will not
Exercise.
exercise. So it will be only
because
premium
long put
profit.
has a right to sell it for 17,500, but the market price is now 17,600. Now, so it is better to sell in the market and not to the counterparty in the contract. Because counterparty to the contract can sell only at 17,500 strike price. So he will not exercise his right. So you will have your premium in your pocket. This is
Only premium.
got it?
Yes, sir.
Yeah. If that
Yes,
is
sir.
the case, now just quickly tell me. Okay. Bullish, bearish. Okay. And let us say strongly mild. Okay. So when you are strongly bullish, what will you take?
Strongly bullish, we will take long call.
Long call. When you are strongly bearish, what will you take?
Long put.
Long.
Long put.
When you are mildly bullish, or rather the correct representation will be, you even need not be mildly bullish, even when you say that the market is lame. Lame means it's not going to move from where it is. Okay, so mildly bullish angle, you can take long, sorry, short.
Short put. Put.
And mildly
Short.
bearish, you can take short.
Call.
Call.
Now let me add one more row. Very strongly. Very strongly means I am absolutely confident. I don't worry about the other side. Then what will you do?
Long call.
You'll go for long futures.
Long future. Okay, okay.
You'll go for short.
Long short future.
See, this is again not something which would be agreeable from a trader's perspective, but because when a trader is actually into the market, though these are the fundamental things he would look at, though giving all these outlooks, actually is the premium trading at an attractive rate, or is the premium actually trading at a very discounted rate, etc. Such thing considerations can come into the trading decisions. At this point of time, let us learn through the basic logic, and then probably we'll come to the trading perspective.
Sir, if we are strongly or very strongly bullish, so we are not taking long call, because in long call we have to pay premium, but in long future we have to pay margin money.
Yeah,
So-
margin money, sir, is applicable in any trade. Let it be cash market trade, futures or options. Definitely. See, because we said what is the advantage of trading through the exchange? Because there is no counterparty risk.
Yes,
By
sir.
addressing the counterparty risk, definitely there should be margin. And margin, remember, margin is not a cost as such. Margin is a caution deposit that is returned back when you cancel the order, and once you cancel the order, you can take back your margin. Or once your order is executed and you complete your obligation, you can take back your margin. Margin is not a donation. It is only a temporary deposit. That's why I use the example. When the students comes to your institute, the caution deposit is actually for 2 years, it is returned back. That is not the part of the cost of the course, is it not?
But sir, as a trader, we have to put huge money to enter long future, and we have to.
No, not huge money, sir. Relatively, it is low money because, say, for example, okay, I'll tell you. What is the cost of Nifty is trading at 17,500. Okay, one lot is how much? In options, one lot is 15. Futures, one lot is also 15. Huh?
Yes, sir.
Yeah. Now, what is lot size? Somebody who's new to it, just to explain. See, in cash market, in ordinary stock, trading, stock trading. See, we can buy 1 Infosys, 2 Infosys, or 3 Infosys, or 4 Infosys, or 1 TCS, 15 TCS, 17 TCS, 1 NTPC, 200 NTPC, 212 NTPC. Any odd number you can buy, depending upon how much money you have with you to pay for the stock. In derivative segment, in futures as well as in option segment, trades are taking place in lot sizes. Okay, lot sizes, which means you cannot say that I want to buy one Infosys in futures or options. 1 Infosys means it means 1 lot of Infosys. So 1 lot could be some numbers. Say for example, Nifty 1 lot is 50 numbers. Axis Bank 1 lot is 1,200 numbers. Okay, Bank of Baroda 1 lot is 9,500 numbers. LIC Housing Finance 1 lot is 2,000 numbers. Bank Nifty 1 lot is 25 numbers. It means that is a minimum quantity at which you can trade in the derivative market. Is that clear?
Yes, sir.
Sir, are you on the same sheet or you are showing some different sheet?
I'm on the same sheet only, sir.
Okay.
My mouse is moving.
Yes, sir.
Yeah. Okay, so are you getting it? So this is not big thing to understand. That is just once you apply 2 minutes of mind on that, that is clear. That is that's a basic difference in futures and options market. We are not talking about one or two underlying asset, rather you are talking about one or two lot sizes. Each lot sizes will be a particular number. Usually one lot means it will be somewhere around 10 lakh rupees is the value. Okay, that is how the lot size is decided. So one lot of Nifty means this is equal to this into this. It comes to 8,75,000.
Okay.
Now, what will be the margin that is required for this? Somebody who is trading in futures. I don't trade in futures. So what is the margin required for one lot of Nifty?
Sir, nowadays margin has been increased to
Still, what is the margin?
75%.
Below 2 lakhs?
No, sir. It has been increased above 50%. Nearby 70% of margin
In
required.
options, it is pretty comfortable. I trade only in options, but this, okay, let us say the margin is 4 lakh rupees.
Okay, sir.
Let us say, I don't think even that is 4 lakh. It will be around 3 lakh or something. Even we can check it a little later. Let us see. Anyway, so what somebody is saying that the margin amount is too high. It is not too high. If you are actually going to buy 50 Nifty in the cash market, it will take you around 8,75,000. But if you are buying it in futures, it will be definitely 2 lakh, or I believe it is 2 lakh or 3 lakh, but it depends upon the broker to broker how much margin they will insist. So usually around 20-25% is the margin that is insisted. Okay, so margin amount is something that is it is basically something not part of the cost. It is part of the money that is blocked till the trade is there.
Okay.
Okay, in options, if you have 2,000 rupees, you can buy a Nifty. Because today I bought a Nifty. What was it? 17,450 is strike price Nifty. It was trading at 38 rupees. So 38 into 50 is the premium that I have paid. So it will come out around 1,500, 1,800 rupees for buying a Nifty. When the class started, I bought it.
Got it, sir. Got it.
Yeah.
I got it.
I got it. Right now, I bought it for 38. Right now, I think it is trading at 50 or 48 rupees. Yeah. So in option, that will be easy. Futures, I don't trade so much, so I don't know how much is the margin required. But then that. What our discussion was, I just wanted you to have. See, this thing you will have slightly more different perspectives as you gain experience. You will have different more explanation to this. It basically depends upon what premium is trading in the market. So depending upon how costly the premium is, you will have your own final decision. But fundamentally, let us say in derivatives, we have totally these 6 positions. A long call and a long put, a short put and a short call. Also, you have a long futures position or a short. Basically, these 3 are bullish and these 3 are bearish perspective. But the intensity to which you are bullish or bearish can be slightly different. Will be if you are very strong that the market is bullish. Market is anyway by end of September 30th, when this contract expiry happens. Next week contract expiry happens. You believe that the market will be definitely 18,000. You are very confident that it's not going to go down. Then probably the better option, better choice for you is to go for a long futures by simply pay premium, avoid long call. But if you have the perspective that the market is already high and still most likely it will go up and up. But in the event that market thinks that let us have a correction and it comes down to 16,000, my fingers will burn. I don't want to take that downside risk. Then probably you pay a premium and you settle with a long. Got it? Yeah.
Yes, sir.
Is that clear?
Yes, sir.
Somebody who is a beginner's level, what is it? How you are able to follow? Beginner's level?
Yes, sir. Yes.
Yes, sir.
Yeah. Okay. See, those who are in the very beginners level, if you at all you find some difficulty, I'll just keep you updated with our next FDP. I don't know whether we'll get an ATAL, but we'll have the FDP on our department will be hosting the FDP. So those who attended this FDP, maybe just give me a mail. I'll just accommodate you. You need not be department FDP is fee based. Okay, so those who have attended this FDP just for clarifying your doubts and just for a passive listening, you can join there. You need not be paying the fees. I do not know when that will happen. Maybe in January if you are having one department run FDP. I'll just give you a mail. Somebody want to listen it, you can come down and listen. No issue. You will not be paying the fees for that. Okay.
Okay, so
Just for facilitating learning. So because I believe it will take 4 or 5 rounds of different sessions or different rounds of programs like this, so that you become reasonably comfortable and the perspectives on various positions. So it is don't worry if you don't get it in the first go. Maybe it will take some time, because even by learning the definitions and other things like in cash market, derivatives market, it will be very difficult for you to convey the meaning to the students. It would require some more this thing. Huh? So okay. So now,
sir, if you allow me for a second only, am I? Hello.
Yeah.
Sir, if you allow me for a second, so that I can share the screen and show you one my query about the margin requirement and why I have asked this question, sir. For
Yeah,
1 second, I
you can
don't
share
need
the
more
screen. You
time.
can share the screen.
Okay.
Yeah, I think I not blocked the sharing the screen. I think you just try it.
No, sir, I cannot.
You're
share
not
the
able to
screen.
share. Okay, just 1 second.
No.
Now you try it again. Check it again.
No, sir. Only host can share the screen.
Allow participants to, yeah, now you try it.
Yes, sir. Sir, if my screen is visible.
Yeah, it is visible. Yeah.
Update on peak margin requirement. I got this mail from Sher Khan. I trade with this Sher Khan on 30th August. So this is the updated margin requirement.
Okay.
So for everything now, big trade and FNO, 75% of margin requirement as the now it is proposed margin is 100%. And also for commodity.
Sir, I'm not very sure about futures, because I very rarely trade in futures. I trade only in options. So in options, basically, whatever is the premium that you have to pay upfront.
Yes, sir. This rule actually applied this year only, and in
Yeah.
last
See,
5 months they have stated from 20% to 100%. In last 5 months only.
Yeah. So I'll just give one more round of one more additional information to this. Can I share my screen now?
Yes, sir. Definitely.
I'm just sharing my screen.
Sorry for disturbance.
No, not at all an issue. See, you're talking about 100. Okay. Can you see a trading window? Not trading window. Quotation window.
Yes, sir.
Yeah. See here. Now Nifty. Just can you narrate? What is this contract? This is options. This is how you read a contract. This is option. What is underlying asset?
We are able to see your Excel sheet only.
Excellent.
It is only
Yes,
Excel sheet
yeah.
which is visible. It is only Excel sheet, sir.
Yeah. Wait. Now you should be able to see.
Yes, sir.
yes, sir.
So how do you read this contract? This is option.
Yes,
Okay,
sir.
so which means that this is not futures, this is options. Okay, so this is options. What is underlying asset?
Nifty.
When is the expiry?
16th September.
16th September.
16th.
Okay, you can have different expiry, but this contract will expire on 16th September. So you have the right to exercise your option anytime till 16th September. What is the strike price?
17,450.
17,450. What option is this? Is it a put or a call? It is a call.
All
option.
European.
So this is a Nifty call, the strike price of 17,450. expiring on 16th of September. So now in a layman's language, what does it mean? If you buy this contract, that contract will entitle you a right without any obligation, to buy the underlying asset Nifty at the rate of 17,450 anytime till 16th of September. So what will be the advantage if you have this in your hand? If Nifty goes above
Yes, sir.
17,450 anytime till 16th of
16th
September, you can exercise this right and make a
Profit.
So you have that power in your hand. So somebody is giving you that power. Who is giving you that power? The counterparty. You are a long call. The counterparty short call is allowing you that you can exercise this right against me. Is it not?
Yes, sir.
If I am the short call, I am giving you the power, and I am agreeing that I will act accordingly. So till 16th of September, if you decide to buy Nifty at 14,450, I will have to deliver it to you at 14,450. If you say that I don't want to exercise it, nothing to do. Both of them can be minding their own business. There is no transaction going to happen.
Sir, if I bought
So
it,
for one more second, sir. So for giving you that power, the short call will charge you something, which is called the
Premium.
premium. What is the premium now? It is
48.
48. See, look at, from yesterday, this has climbed at 50%. Yesterday it was around 22 rupees. Now it is 48 rupees. So if you are looking in the cash market, 50% gain overnight is not possible. It will take 6 months or 1 year sometimes to make this profit. I had one lot of this yesterday, bought at 20 or 21 rupees. So this is 48 rupees. So it doesn't mean that you can easily make money, but these types of this is the possibility that if you correctly pick an asset, you can make a gain in the option. Now, what was I telling? Okay, so this is Nifty. What is the underlying value of the Nifty? Now Nifty is trading at what rate? This is the spot price. This is Nifty in the cash market. Yes or no?
Yes, sir.
So what is these two value? This is the strike price, the rate at which you can buy it. And what is this? The current
Market
value
Spot
of it.
price.
So is it in the money?
Yes, sir.
Yes, sir.
Yeah.
Yes,
Because
sir.
you have the right to buy it at 450. It is already 459. So 9 rupees you can anyway. It is that will bring you a profit. But remember, 40 rupees, 48 rupees premium is paid. So how much Nifty should climb more so that you will get a net profit?
You ask anything, sir? Any
Yeah.
question?
Please
how much
repeat the question.
Nifty should climb so that you will finally come into a net profit? At this point, you will not get a net profit.
Sir, 17,498.10.
About that, it is going to give you pure cash. Okay, at this point of time, we can understand it like that. Now, as a trader, before that, I wanted to say something. So what is the Nifty size, lot size? I said it is 50. So how much should I pay for buying one lot of Nifty? 48 into 50 rupees, around 2,500. Lot size is 50. I have to pay only 2,500 for buying this contract. That's what I said. I need not be looking at what is the value of the trade. 50 lot of Nifty means 17,450 into 50, it will be around 8 lakh rupees. So for buying this contract, I need to pay 48 is the premium, 50 is the lot size, 48 into 50, 2,500 rupees only I have to pay. 100% I have to pay. That is what you are showing in the slide. Okay.
Okay, sir.
On that, earlier you could give even the 500 rupees margin, you would be able to trade. But now SEBI has made it mandatory that there should be peak margin.
sir, may I ask few questions?
Yeah.
Sir, the expiry is 16 September, and suppose yesterday I have bought it. So can I sell it today?
Usually people sell it within 5 minutes, 6 minutes. You don't even hold it for overnight.
Sorry?
Most of the trade happens, the life of most of the
Yes,
trade will be less than half an hour.
Anytime we can.
Now
sell
you just refresh it, you can just look at the difference. It is already 49.95 now.
Okay. So I can
So what
exercise.
is, so if you
time-
had bought,
No.
10 lots, by now you would have made how much? Is it not?
Sir, I think his question is different. His question is, can I exercise? No, exercise word is different, and buying and selling is different.
Yes, sir. That is what I am asking.
नहीं,
You
आप
mean exercise means?
कॉल यूरोपियन को आप एक्सरसाइज सिर्फ
Yeah.
लास्ट डे में कर सकते
Only
हैं।
expiry पे ही होता है ना वो तो।
See,
नहीं, तो आपका बेचना
all,
इज नॉट एक्सरसाइजिंग फॉर
Yes.
से आई परचेज्ड इन 21 रुपीज और 1 घंटे के बाद आई सेल इट फॉर 48 रुपीज, so this is buying and selling, this is not exercise.
that's only a trade.
Exercising means you are actually converting it into a share and you are taking delivery, isn't it,
That
sir?
is what I am saying, sir.
Yeah, the
Actually,
delivery
if
is
you-
possible only in stocks. See, Nifty
Yeah,
is
yeah.
all net cash settled. I don't
Yeah,
think
yeah.
somebody is actually going to delivery. Very rarely somebody will go.
No, sir. I am not asking about delivery. I am asking about the pattern of settlement. That if I bought it and on, as you said that yesterday it was at 22 point something rupees. So can we take it as an example that suppose I have bought it at 22 point something rupees and today, one case is today I want to get out of this contract. So how much will I earn?
Okay, I'll just show you one example. Let me
Earn
just.
equal to premium, difference
Okay,
of premium.
you can see this window.
Yes, sir.
Yeah, this is my actual trading account. So before the class started today, I bought one lot of Nifty. I think I bought it at average price of 38.
Okay.
Okay, now what is the rate?
50.
3.55.
50. So what to answer your question, I'll simply do this. Though I have put the price at 66, I'll just put it at 51. Okay, now I put it, so that would have got executed. Is it not? So that I got executed. So what it means, I bought it for 39. At what time did I buy it? Look at it. I bought it at 9.55. Today 9.55, I bought it at 38 rupee
38.58.
60 paise. And I sold it at right now 11.28. I sold it for 51 rupees 70. So you can, if your question is whether you can what is it, buy it and sell it, yes, you can buy it and sell it. Even if you bought it yesterday,
The profit
it
is
doesn't mean
equal
that
to
you
the
have to wait till
difference of the
16th of September.
Yeah.
You need not wait it till 16th of September.
Okay. So, sir, the difference between these two prices will be my profit, right?
Yeah. So my profit here would be around 12 rupees and around 1 rupee. Let us take it for the brokerage. 20 rupees. Okay. Around 10 rupee, 10 into 50 will be my profit in this case.
Okay. And sir, what happened on 16 on the expiry? If I take it
So
up
on
to
16,
expiry?
sir, two things can happen. Many of the traders actually make a mistake. So there is something called the time value of an option.
Yeah.
Yes.
So which we will discuss. I think we have to discuss that in detail. We'll discuss that later. But just to answer your question at this point of time, 16, if Nifty trades above the strike price, your contract is definitely in the money.
Sorry, can you
But if
repeat?
Nifty
sir?
trades
What
below
did you
the
say?
strike price, there is no time value for that. That is, there is no more time that is available for you for more things to happen in the market and for Nifty to rise. So time value will be zero, and therefore your option will be worthless.
Okay.
See, you take another contract. Let me tell you. Okay, let me just take this. Okay, what is the Nifty? It is 465. I will go to for 17,700. So the Nifty is 17,700. Strike price is 17,700. Okay, what is the Nifty trading now?
17,462.
I will just put it a little more down. I'll put it at 550. Okay. Yeah, it is 17,450. This the strike price is 17,550. Okay,
Right.
so Nifty is only 17,459, but the strike price, this contract strike price is 17,550. But even for that, there is a premium of 12 rupees. Why should there be a premium of 12 rupees? Are you getting it? Nifty is actually trading below the strike price. So you are going to buy a contract which gives you the right to buy Nifty
at a higher price.
higher price than the current Nifty price itself. Even for that, you are paying a premium of 12 rupees. So what is this 12 rupees all about? This 12 rupees is the time value of the contract, which means till 16th of September, today is 15 only now. So there is another half day trading today. Half of the trading is already completed. So half day trading is there, and tomorrow one full day trading is there. So during this trading time, many things can happen in the market, and these can actually lift the Nifty up and up. So I am giving 12 rupees for that possibility, is what I mean by the time value of money. Are you getting it? So
Right.
instead of 16, if this contract is available till 23rd, there is even longer time. There is even longer time. More happenings can take place in the market, and it is likely that Nifty will reach above 17,750. More than likely in a period of 16 September. So what I'm trying to tell you is, if you increase the time from 16 to 23rd, you can simply see the time value is increasing. Are you getting it?
Right, sir.
Yes, sir.
Why is it increasing? Because
the time
it is
is
more likely that Nifty will go above 17,750
right.
till 30th of
Chances-
September and
chances are higher.
16th of September.
Probability is high.
Okay, so here it doesn't have an intrinsic value. The Nifty is already trading below the strike price, but still this contract has a time value.
Time value.
So on the expiry date, what will happen? The time value will completely go up, because on expiry, the contract is dead. So there is no time value. Are you getting it?
Right, sir.
So in expiry, only if there is an intrinsic value, that will reflect in here. Did I put it correctly, sir? Somebody
Right,
there
right.
with trading exposure?
Sir, one last question related to this. That is there anything? I mean, is it like there is no intraday trading in options? Or is it there?
Intraday or intra-minute is also there, sir.
Okay.
See, most of the trade. See, it depends, sir. See, like I said, I showed you a real example. That is intraday only, na?
Right. Yeah, that is
Our
intraday.
class started at 10 o'clock. I was just looking at the market. I was just looking at the technical charts. I bought one contract. I just showed you now. What is it? I bought a contract 17,450 at the rate of 38 rupees. Since somebody asked the question, I checked my order book. It is trading at 50 rupees. I sold it in front of you. Now that is
Right.
intraday.
That is it.
That's intraday. You can hold it for another till 16th of September if you want.
Okay. Right.
Maybe till
Thank
16th
you so
of
much.
September, that will get you somewhere.
Thank you.
Sir, what will happen if you have not sold on expiry day?
Sir, if you are not sold on
Premium
expiry
gaya.
date, the system will actually drive itself.
You hold option, time value will be 0.
Zero.
Premium 0. Option रह गया, आपका premium गया. All premium gone.
You have to exercise. You have to. I think sir, now the rule is, you have to mandatorily exit your position, na?
Sir, if the option value at the end of the contract is
Usually
suppose
what brokers do is, if you are not exiting, and if you do not have appropriate margin money, maybe towards very close of the expiry of the contract, they will actually sell it off at the market rate. If at all it has a value. If it doesn't have a value, आपका premium गया. Whatever premium you given, that premium is gone.
sir, if the premium value is 0, then there will be some charges also.
No.
The brokerage
The
charges.
you already given. The premium. See, now if you want to buy this contract, you have to pay 112 rupees.
Sir, brokerage charges.
No. This is premium charge. Brokerage will be some, see, for one lot, it will be 20 rupees.
Brokerage
These are
and
fixed rate.
taxes
For
are
one contract,
different.
if you're buying one contract, usually the broker, depending upon your trading volume, they'll fix a rate for you. That is not very important, because that is very negligible. 20 rupees will be for one lot. That is for 50 numbers. It will be 20 rupees.
Okay, sir.
So brokerage is something different. This is the premium that you're paying. So
Also, sir,
so what
brokerage and
happens in an
taxes.
options market? See, what is your objective? Finally, your objective in an options market is what? You're buying it for 12 rupees 90 paise. When the class is over before 3:30, can you sell it at a higher rate? Now see, it has become 11 rupees 35 paise. So now if you sell it, which you bought it for 12 rupees, the market price is only 11 rupees 35 paise.
Yes.
So you will lose how much? 1 rupee 75 paise has come down. So 1 rupee 75 paise into 50 is your loss. So
Yes,
you'll have
sir.
to again keep on watching. It has become 50, is it not? So you have to keep on watching. If it goes above 11 rupees, 112 rupees above your purchase price, you can sell it and you can make it.
Oh. And
So this,
brokerage and
so
taxes
what is your intention is, you are talking about all these fundamentals, like the spike price is 17,550, the underlying price is only 462. This price, if it goes high, you will make a profit. That is the theory. But actually, when you make a profit, is when this underlying price starts going up, these contracts become more valuable and attractive, and therefore this premium will go up. So what you have bought for 112 rupees, you will be able to sell it for 115 rupees or 20 rupees. Or what I sold you as in the morning, I bought it for 38 rupees. Now I sold it for 51 rupees. So you are, as a trader, your eye is on. You have bought a contract at a particular rate of 100 or 30 or 38 rupees. Can I sell it for 40 or 45 rupees? Is your time. And how that contract will become 40 or 45? Depending upon how the spot price will
move.
the spot
Yes.
price increases, that will get reflected in the
Premium.
Is that clear?
Yes, sir.
Don't jump into option market without basic understanding. If at all, on the other side, there are people. I also believe that the best way of learning options is by putting your hands into. But when you're putting your hands into, don't go for large size. Go for single lots. Say for example, best thing is you go for a nifty single lot. How much will you lose? See, 30 rupees is the premium, 50 is the lot size, maximum 1,500. No issue. Don't go for 1,000 lots or 500 lots at big premiums, and you may not know that you are making a loss in options. That is a problem. All of a sudden, next day you will see that the market is closing from 100 rupees. Your time value will become 0. So there is some basic understanding you will have to gain, which is better. Even you have a simulated trading environment. Zerodha has it. Many IndiaTrade.com has it. So without putting money, you can just simulate your trading. That is also possible. I think one of my students, James Dominic, I think he will be taking a session on this. I think on Thursday or Friday. That is possible. Yeah. Can I proceed? Sorry, I started at yeah, it is only 11:30. 11:30. I can proceed. Do you want a 5 minutes break?
Sir, what will be discussed in next session?
We'll break for 5 minutes. We'll start at 11:45. I will continue here. Those who want to ask something, we can continue. But others, those who want to take a break, can take a break and come back at 11:40. Is that fine?
Sir, what we will
Yeah.
discuss in next session after 11:45?
After 11:45, sir, the next session is at 1 o'clock because she is having another session at 3:30. So I
Sir,
had to
what is the
leave her
topic?
at 3 o'clock. So we are
What
starting with option strategies.
option strategy?
Yeah.
Okay, sir. Thank you, sir.
See, when you discuss option strategies in a way, again you will be discussing the payoff. So that is a reinforcement of what we have discussed as payoff in the initial classes. Okay,
Okay, sir.
so option strategies, I would like to just spend 10 minutes before we wind up on option strategies so that it will be easier for you when you start with Lakshmi, madam. So I'll just ice break, what is an option strategy, and I will leave it to Lakshmi, madam. Option strategies, we will have it in the next session. And in the end today at 3:30, we are having a session by Vinayak Gunda. He is from NSE, National Stock Exchange. So all these kind of doubts, which probably I may not be aware of, or slight small things like uh, 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 at what time the exchange will run the scoring of orders which are outstanding, or all those exchange related microstructure of the market. Vinayak will be able to clear it. He'll also touch upon clearing and settlement also. That is another one session today. After that, tomorrow again we are on option strategies and we are discussing Greeks. Huh? Greeks are there. You can just have a listening to that. Maybe 1 or 2 rounds of explanation will be required to understand Greeks. So tomorrow the first session will be Greeks. We will discuss it from a theoretical perspective. Professor Saji will be discussing that. After that, the next session will be by Binu, who will be discussing the same Greeks from a trader's perspective using spreadsheets. Okay. Some audio problem. Do we have an audio problem?
Yes, sir, we have audio problem, sir.
It means some mic is on.
So some sort of a noise is coming in the background. Yeah, now
Now
it has been.
I
Yes,
think
sir.
somebody's mic
Yes.
was on. That's the problem.
Yes, sir. Yes,
Now
sir.
it's okay. Now it's okay.
Now it's okay. So can I continue with something more? Because I'm just pushing a little too much in this initial session, because only this is discussed reasonably. You will be better able to make out in the strategy session. So I'll just.
Sir, in this exactly, how much have you invested?
Where, madam?
The same thing which we were seeing that lot.
See, madam, for buying one lot, what was the price? I'll tell you.
110, no, sir?
No. Today, I bought that contract for 38 rupees 85 paise. The strike price was 17,450. I'm correct. So 35.85 into what is the lot size? 50 is the lot size. So 1,942 rupees.
Okay.
That much premium I had to pay.
Sir, there is a personal question.
Yeah.
Which technical indicator you use?
I basically, apart from all the technical indicators, finally, I trust basic line charts only. I usually take 3 minutes, 30 minutes, 1 day, and 1 month charts together.
Any specific indicator?
The
Moving averages.
I usually go with like moving averages or RSIs or indicators which I usually go, but finally my decisions are based on only line charts.
Okay, sir.
Basically, like
I
it
think
doesn't mean
price
that
action
is
is
the best tool. It means that it depends upon each person's personality type, mental cognitive flows, etc. It is something like somebody would be would like to have a left hand drive. Somebody would like to have a right hand drive. Is it not? Somebody would like to have a two-wheeler to ride. So it is basically it depends upon what type of indicator you are better able to relate. And what is more important is the relationship with the marriage with the indicator. You are 10 years with that indicator, you are more comfortable. So maybe I'm using it for the last 18 years, I can probably better relate the fluctuations in that. So if I all of a sudden start using a different indicator, though it will be more contemporary or new, it will take another couple of years for me to adopt what is in that. It is something like you would have seen old people looking at the weather and saying whether it will be raining tomorrow or today or like that. It is not articulated as to what is the science behind it, but it is probably the 60 years, 70 years of experience and exposure with the atmosphere, with the surroundings, that the changes he is able to sense and able to give an opinion. Correct. So, different people will have different indicators. So, if you ask what indicator, they can only broadly say. It will be very difficult as to explain how you actually decide that. But now slowly there is a theory of body of knowledge that is developing for technical analysis. There are a lot of tools. The balloon bands are there. I do not know. There are so much of tools. I'm trying to study those tools, though I am not adopting all those. I wish I could also have a session on technical analysis somewhere next year. So just looking at it, let us see. But there will be different people who are among you also. Those who are trading, you will have your own style of actually picking up what kind of indicator.
Sir, if we talk about the RSI indicator, it shows that if it is moving above 70, then it is in the overbought position.
Yeah.
But some stocks on the monthly chart, so long-term chart, they are trading at around 90 RSI.
Yeah.
Then why there is no correction in those stocks?
Sir, that is what I said, sir. That indicator per se does not actually see. You are working in the hot sun and you take a thermo sensor meter and measure your temperature. It will show you definitely a higher temperature because the body is being exposed to here, heat. It will not be a natural temperature, no?
Yes,
Okay.
sir.
But you are sitting in an air conditioned room and you are testing your temperature. Definitely, your body temperature would be to an extent lower. Okay. So what I'm trying to tell you is, sir, overbought means there could be a reason why it is overbought. Say for example, Tata Motors is being overbought. You could see a high RSI if I'm correct recently because Tata Motors have come up with new models. They are actually now successfully introducing battery vehicles. So fundamentally, there is a reason that they will get an edge over other players in the next coming years. So there is a fundamental reason as to why a stock is all people are actually trying to buy this particular stock. So it is a question whether the logic follows the indicator or the indicator follows the logic. So indicator per se does happens because there is some logical reason as to why that happens. So we have to investigate that logical reason. So why is it overbought? Overbought means it is being bought more than a particular benchmark volume. So why is it overbought? It is overbought because there is some reason or fundamental reason behind it. So if you are confident with that fundamental reason, then there will be a ride on that.
Yes, sir. As if we talk about this, yesterday it rose around 40% in cash on spot price.
Yeah.
Yes, sir.
So that could be RSA and all. These are only broad indicators. It is not that it is not a final point where you can make an decision. You cannot say that RSA is high, so therefore let me stop sell it, or RSA is below 30, let me buy it. If it is underbought, just look at is there any reason why it is underbought? Say for example, you look at Petronet LNG. RSA, I think it is very low. So there could be reasons, is it not? So you can use it to shortlist the stock for making a decision, but per se by going by that sometimes can be risky. Okay. Now just it is 50. I'll just in 10 minutes let me just take you through few more things. Again, I'm taking NSE. I'm taking the market data. I'm taking derivative segment. Okay, see in derivative segment, if you look at, you can have stock futures, stock options also. I'm concentrating on options. So let us take which one you want to take. Bharti we discussed yesterday. Mindtree. We'll take Mindtree. Mindtree is something which is on the verge of a breakout. Yeah. So which is the underlying asset?
Mindtree.
What is a spot price? 1,144. Okay.
444.
Yeah, 1,144. Okay. What is the contract? Which is the contract? Which is the contract? This is Mindtree. Mindtree options, but Mindtree what options? Mindtree call option. It is not a call option, it's a call option. Still that is not complete. Mindtree September 30 call option. It can be October or November also. Are you getting it? What do you mean by September, October, or November? September call option means this option expires on 30th of September. Last Thursday, 30th of September, it expires. This expires on 30th, 28th of October. This expires on 25th of November. So when you are identifying a contract, this is a Mindtree September call. Even then it is not complete. Mindtree September call, you can have so much of strike prices. Which strike price are you referring to? You are referring to. So now which is a contract? Mindtree September call with strike price 4,000. So what do you get if you buy this contract? You are getting a right to buy Mindtree. You don't have an obligation to buy it. You're having a right, you're buying a right to buy Mindtree anytime till 30th of September at the rate of 4,000. This 4,000 strike price. For buying this right, how much should you be paying? How much should you be paying? The current last price is 226 rupees. So you will pay 226 rupees for buying this contract. So what will be your objective? You buy it for 226 today evening or tomorrow or anytime till September 28th. Can you sell this to somebody else for more than 250? Are you getting it? You bought it for 226 today. If I am able to sell it for 240 rupees, I make a gain of 14 rupees.
14 rupees.
Now the question is, from 226, how will it go to 240? There are 6 factors which will influence the option price, which we will discuss. But one of the most important factor is, or evident factor is, this should simply go up. If the underlying value keeps on going up in the spot market, obviously the value of the contract will be higher. Because you have already the right to buy it at 4,000. Now it is already 4,144. If it goes to 4,300,
yes,
the buyer is having so much merit because I have the right to buy it at 4,000. Now it is 4,300. If it goes to 4,400, all the more I'll have better value for this contract. So that is how the price of the contract will take in the market. Is that clear?
Yes, sir. Yes, sir.
We'll come again with that. Just let us discuss some more thing in this. Now, this is once again what contract? Mindtree call, September call with strike price for 4,000. Now, if I change it from September to October, what will be the difference?
Premium will increase.
Yeah, premium will increase. Before that, when I change from September to October, I am having more time. Like in cricket, you want to know your target is 300 runs. You have or your target is now 100 runs to win. You have 10 hours. But all of a sudden, umpire says that there is some penalty from the bowler. So I am giving you 2 hours extra. So I have 12 hours. So my probability to win is much higher. Is it not? Same thing. The contract I am choosing is September. Fine, till September only the contract is live. But if I am choosing an October contract, I have 1 more month. So during that 1 more month, more things can happen in the market. The share can go up or it can come down. If it goes down, I am not worried because I don't have any liability to buy it. I will only lose my premium. So if it goes up, I am more happy. So October contract will be more valuable than a September contract. At least see, September contract is only 140. I'm not changing the strike price. The underlying value is not changed. Only the date has changed. It suddenly becomes 200. Sorry, 336. Are you seeing that? 30th it is how much? 111. October is 336. Are you getting it?
Yes, sir.
And if I go
Yes.
to November, what will happen? And if it goes to November contract is not traded, that's why it's showing 0. But just for your understanding, from September to October, as time to expiry increases, the value of the call will also increase. Value of call as well as value of pay, both will increase. Is that clear? Yeah.
Sir, when we selected the number, it becomes 0. That means there is no one who
No, that contract has not started trading.
Okay, there is no counterparty.
Yeah. See, if you look at the bid and offer, there is nobody who is trading in that right. So maybe after 2 weeks, somebody will start trading it. Because trading has not been into that. Okay, now, so I explained you what happens with different ticks. Now, what happens with different strike prices? Will you be happy to have a strike price of, now it is 4,000. Will you be happy to go in for a strike price of 4,050 or 4,000 or 4,950? Which will be better for you?
4,000, 3,090.
If you go for a higher strike price, it means that you are getting the right to buy the underlying asset at a higher price. So you always want to buy it at the lowest price. So as far as a call option is concerned, you are buying a right to buy. So when you are looking to buy something, you want always a lower price to buy. So you have different prices which you can choose from. So from 4,000, if you choose a 4,950, what will happen? Your right is even more attractive, which means observe the premium. The premium will slightly be higher. It is 123. You even choose a lower premium, it will be even higher. Even if you choose a lower premium, even it will be even higher. And on the other hand, if you go for a higher and higher premium, your contract is lesser and lesser attractive, and therefore you need to pay only more lesser and lesser premium. Is that clear?
Yes, sir.
Okay.
So please repeat it.
Yeah. See, what I'm trying to tell you is, when you're talking about an option, you have certain things to choose. One is what is the time to expiry. So you can choose a near month contract or a far month contract. A near month contract will have some value. But if you choose a far month contract, okay, it is 111 rupees. So from September, if you take an October contract, the value of the contract or the cost, the price you have to pay to buy this contract will be simply higher because you are getting one more month to experiment your prediction, whether it will go up or not. So it is likely that the share will go up in 2 months than in only 1 month. So therefore, you have to give a higher value. That is the first thing that I was explaining. Second thing that I was explaining to you is, while you are deciding to buy a contract, you can also decide which strike price you want to buy. There are a lot of strike prices which you can choose from. So this strike price is having a, with this expiry date, your premium is 136 rupees. Now, if you choose to buy a same contract with a lower strike price, which means instead of 4,000, now you are getting the right to buy Mindtree, which is underlying asset at the rate of 3,990. It is better for you.
The last price is the premium, no, sir?
Oh, I highlighted this. Yeah, this is the premium.
Right.
I was highlighting the change. Sorry, I was highlighting the change. This is the premium. Yeah, just look at this column. Yeah. So if you are from 4,000, if you are coming to 3,950, will it be better? Do you want a right to buy it at the rate of 3,950 or 4,000? Which one do you want?
3,000.
Lower
price.
Lower price. So therefore the what is it? So September. Yeah. Therefore, see, you look at what is 4,000. What was the premium? 4,000. The premium was 226. So if you go for 3,950, the premium is higher, 260. If you even go down, it will be 380. If you even further go down, that will be even larger. And on the other hand, if you start going up the strike price, your premium will be lower. That is the basic things that you have to understand.
So it means that the lower the strike price, higher will be the premium for the call option.
Now, if it is for a put option, what will be the case? I'm changing the option to a put option. So what will be the case?
Just
for a
reverse
put
of the call option.
Put option, you are buying the right to sell it. So this explanation is the same. As the time to expiry increases, both call and put will be more costly. It is 169. If it is a September, it will be only 91. So the same explanation in the put option, you want the share price, this value to fall as low as possible. So till September, you are expecting it to fall. But if you are giving one more month time, it is likely that you can be more sure that it will definitely, not definitely, it can be more likely that the underlying value will be falling. Therefore, for that more likelihood of your predictions to come true, your contract is more worthy, and therefore for that reason, an October call will be more costly than a September. That is applicable. The same thing for a call and a put. Is that clear?
Okay, sir. Clear.
Okay. The recording is on, no? Yeah, it is on.
Yes, sir.
Don't forget to press the recording. Okay. Now coming to this second one. See, for a put option, earlier for call option, we discussed as the strike price goes lower and lower, the contract will become more and more attractive. But for a put option, what is it? You're procuring the right to sell the underlying asset. So do you want to have the right to sell it at the lower price or the highest possible price?
Highest.
You want to have the right to sell it at the highest
price.
possible rate. So therefore, if from 4,000, if you choose a contract of 4,050, you can see the prices increase. If you go to 4,150, okay, there is no contract in that. Let me take 4,050. If you come down to 3,090, it will be not that attractive. And if you again come down, it will be lesser attractive. If you again come down, that will be even. Okay. So what you want to take away from this is, as time to expiry increases, the premium that you have to pay for the contract for both a call and a put, both will be increasing. It will be more costlier for a longer duration. And another thing you have to choose is from the strike price. As the strike price comes lower, call will be more attractive and put will be less attractive. As strike price increases, call will be lesser attractive and put will be more attractive. And another one more thing that we have to take is, finally, our eyes are on this particular value. You bought it for 25 rupees 65 paise this contract. Can I sell it for 26 rupees, 28 rupees or 30? So that I can make it. So then in my next session, what we'll be discussing is what will actually trigger this premium price to go up or because 6 factors to discuss. We'll discuss. Okay. Now it is 12 o'clock. So as I requested, I would like to have 10 minutes just to introduce to you what is a strategy. Don't expect to understand what is a strategy, just to get a feel of what is a strategy, so that you can have a better landing when you start with Professor Lakshmi in discussing strategy. Can I take another 10 minutes? Okay. So see, to start strategy, the basic question is, what are the basic? My Excel is visible to you now.
Yes, sir. Yes, sir.
So what are the basic option positions? We already discussed that. What is it? Long call, long put, short call, and short. These are the basic option positions. Depending upon your outlook that we discussed here, you can choose your what is it? Your basic option position. Now, in a strategy, what it means is, in a layman's language, you are combining 2 or more option positions together at a time and approaching the market so that you have a better what is it? Expected outcome from your intervention. So you're bullish, but you are not going with the long call alone. You're going with some combined positions so that you can get a better. There are around 20-21 popular strategies. So I'll just to give you a feel of what is a strategy, I'll just give you one small and very easy example to understand what is a strategy. For there, Professor Lakshmi will be discussing this once again, but just to have a basic understanding, I'll just give you. Okay. So now the context is see election results. maybe the previous batch participants who are there would come across the same example, but then practically this is one. Huh?
अच्छा है पर जैसा कई बार ना ऊपर से चला जाता ऊपर से ट्रेडिंग जैसे वो इंटरडे के बताते हैं ट्रेडिंग के बारे में बता रहे हैं कि ऐसा ऐसा
So context is like election. So election basically unarguably in any election result. Sir, please take your mic, sir. As you
Mr. Swaroop, can you please take your mic? Mr. Swaroop.
Muted it. Yeah. So what is happening? What is expected to happen in election result month or even in budget month? What is expected to happen?
Huge volatility.
Yeah, there is huge uncertainty from a layman's perspective. There is huge uncertainty. Anything that we listen to CNBC, NDTV, or we listen to the finance minister directly, still there is always a gray area as to how it will come and how the rest of the world, the economy and the society will take the budget or take the election. So there is huge uncertainty. So when there is huge uncertainty, what will happen? If after the result outcome comes, the market takes the outcome favorably, there will be a huge, or there will be a huge. This is what is, I talk about the uncertainty event. This is possible. I do not know whether the market is going to go up after the result or come down after the result. But I am very sure that once the results are come, the market will either take it positively and that will go to a different high level, or the results are in an unfavorable manner. I do not know. The market will actually fall down. So only thing what I am sure is the market is not going to stay where it is. It will either go up or it will come down. That is my setup. That is my context. So I'm talking about a particular context. Every time we cannot have this context. That is why I said an example. Let us see on the election result time or during the budget period. So now if you ask me, I cannot say I can imagine this context. I have to wait till February. Is it? So are you with me? Can I continue?
Yes, sir, we are with you, sir.
So what is the context? I'm talking about a hypothetical situation where there is an event to happen and the outcome of the event can definitely influence the market up or down. But only what is the problem with me is I'm not able to predict what will be the likely outcome. I have no clues. Whatever is the outcome, that will definitely ride the market, but I do not know what is going to be the outcome. In such cases, what I'll do is, right now, what is Nifty? Right now, what is Nifty? Nifty is 17,400. Let us see. This is spot. So, after the event, if the event is positive, I feel that the Nifty will go to 19,000. Or I feel that the Nifty will come down to 15,000. Okay, 15,000. So this is my calculation. Nifty is trading at 17,000. So in next 1 week, the budget or the election result is going to come. Once it is announced, the Nifty will be at 15,000 or Nifty will be at 19,000. But I am not able to make any idea as to which is more likely. In such situation, what I will do is, let us say September call, September Nifty call with strike price equal to 17,500 is trading at 200 rupees, and September Nifty put with K equal to 17,500 is trading at 2. So tell me, what is this? September Nifty K 17,500 trading at 250. What does it mean? What does it mean?
200 is the premium for the call.
Yeah.
Call for
200 is the call premium.
For the put.
This is the put premium. So if you want to buy a call with strike price of 17,500, you have to pay a premium of 200. If you want to buy a put with 17,500, you have to again pay, let us say, a premium of 250. But will I go and buy this? Given this context, will I go and buy this? Fortunately, if Nifty goes up, I will make a profit. But I do not know whether Nifty will come to this also. Is it not? So in such case, what I'll do is I'll take a position where I go long, call, and long put with same strike price and same expiry date, T minus T, expiry date, time to expiry. So what is the position I am taking? I am taking a long call and a long put with the same strike price and with the same expiry. I hope you understand, what is the same strike price. Just now, so for every contract, there could be a lot of strike prices which are available for you to choose from. For every contract, there are different tenures, September, October, or November, different tenure which you can choose from. So here my strategy is I am going to take a long call and I am going to take a long put together with the same strike price with the same time to expire. Is that clear?
Yes, sir.
So what will be my total investment? Or what will be my total cost of premium?
450.
It will be 450 rupees. Because 200 for call and 200 for put, 450. So I spend this 450 rupees and I am waiting till next week for this event to happen. Let market break down or like market fly down. So now let us say next week, suppose market, the results came and market went to 19,000. What will happen for me then? What will happen for me? What are my positions? I have a long call and I have a long put. So what
Sir, in long call, you will get 1,500.
Yeah, what will be my this thing with long call?
1,500 profit minus
You will
200
get
premium.
900 minus what is the strike price?
17,500.
17,500 is a strike price. And how much premium did I pay?
200.
Yeah, minus. Okay. What about my long put? Long
Your
put,
loss, 250 loss.
yeah, because long put you're having the right to sell it at 17,500, but the market is already 19,000. So the put will go worthless. The premium that you have paid, 250, will actually completely go. So therefore, what is your net profit? The net profit would be
1,050.
1,050. Now, suppose after the results, Nifty comes down to 1,500. Then what will be a position in long call? You have the right to buy Nifty at the rate of 17,400, but now it is available at 15,000. So will the call have any value for you?
No, sir. 200 loss.
So the premium that you have paid is already gone. That is a loss. And what about the put? What about the put?
2,500 profit minus 250 premium.
500 is the strike price. This is the Nifty, and the premium paid is 250. So 2,002. So what is your net profit? So now
2,050.
So what can you conclude? If the market goes up or if the market comes down, you will always end up in a profit. If the market is going up 19,000, your profit is there. If the market falls down to 15,000 also, your profit is too. The market goes to 20,000 or 21,000 also, the same thing. You will have a profit, which means let the market crash or let the market rise, always you will end up getting a profit. Are you getting it?
Yes, sir.
But you cannot adopt this always. Only when there is a swing. Suppose the results comes and unlike your prediction, the market remains at 17,500 itself. What will happen? You lose. There is no work for both the contracts, and you lose both premiums, and your loss will be minus 200 and minus 250. So this situation should not happen. That is, the market should not remain where it is. The market remains exactly at the strike price, you will have huge loss. So what you should be looking at is, you should be ensuring that the market either crashes down to a lower level or it flies to a higher level. Either case, you are safe. If the market falls or market rises, you will definitely come out with a. This is called a straddle. Draw a payoff, it will be something like a straddle. It will be like this. If you draw a payoff, I think the Professor Lakshmi will be explaining how to draw the payoff. Okay, so that is a straddle. So when will the straddle strategy fail? Against your prediction that the market will either fly or crash, if the market actually decides to stay where it is around the strike prices, then both the contracts will expire worthless and your total premium will be a loss. But usually when election results come or in budget events, market does not stay where it is. Either it crashes or it goes up. So therefore, in such situations, we can make a strategic interventions in the option segment and make a profit. So here you are combining a long position and a put position to make out a profit. So like that, for different outlook, different setup that you imagine for the market, you can have combined positions using. There are butterflies where calendar spreads. So there are condor spreads are there. So there are different strategies where which you can adopt, and you can actually have a better takeaway from the market rather than going with simple option or basic option. Is that clear?
Yes, sir.
Yeah. So if there are any clarifications, you can put it. Otherwise, I think we'll have a short break today because after today, I think we'll have a relaxed intervals. But today, since Lakshmi Madam has another class at 3:30, I think we had to schedule it at 1 o'clock. If you have any doubt, we can clear it. Otherwise, we can break. Please come back and join at 1 p.m. itself. Because if you miss the earlier part, since that will be mostly based on contextual data and spreadsheet. If you miss the earlier part, it will be very difficult for you to catch up. So please be back at exactly at 1 o'clock. Anybody has any clarifications? Yeah, international events can also affect the trend in the market. Yeah, that is also possible. When there was a Taliban issue, yes, probably we would or if there is an action that is coming in, we can expect that either it will be for good for the market or so. Any international events can also appreciate if you can explain once again using live screen. Plamana Madam, what do you want me to explain using live screen?
It's okay, sir.
Yeah, madam.
You have already said it.
Madam, I can't hear you. What is it? Plamana Madam? Yeah.
Can you hear me, sir?
Yeah.
No, you already explained. I just wanted to see, how it goes on live screen. And get like how.
Did I show it already, or you wanted me to?
Yeah, you've shown it with respect to.
Okay. So shall we break now, because by 1 o'clock we have to start again. If anybody want to ask something, you can continue asking. Others can leave for the lunch. Please join back by 1 o'clock. I know I extended 20 minutes for my session. Only that though I did not plan to introduce strategies, but then if you have this basic understanding of what is strategy, you could just keep your mind tuned as to what the next session will be happening. Be helpful. That's why.
Sir, good afternoon, sir.
Yes, Smriti sir. Yeah.
Sir, actually, the thing is clear, but for practical aspects of trading, what you have shown, You want to enter into the enter into that platform.
Sir, it is always advisable that you have a learning curve. Don't directly go into trading without understanding the basic properties of an option, because option can hit you very badly if you do not know.
Yes.
Because all of a sudden you will see that your money is completely gone, because some things, there are different variables that are affecting the option prices. So you should be careful as to, only thing is that you need to be a knowledgeable trader. Knowledgeable means you should know the properties of an option. So we are going, I think maybe by 2 more days, maybe by tomorrow and day after, we are having more of trading kind of sessions using Greeks and all. So we should be able to do that. But definitely spend effort on understanding the properties, because unless you understand that properly and only you concentrate on trading technical side, that can bring you harm at times. So don't rush into that. Apply a little more patience and definitely go with the smaller lots. Like I said, you don't go with stock options. Go with only index Nifty options, so that you have smaller premium to pay. Like you go for Nifty or something, 1,500 is the maximum investment that you don't go for stock option where you'll make 50,000, 70,000. Okay.
Sir, what will be the duration of the next session?
Again, 2 hours, 1.5 hours, 1.5 to 2 hours. Okay, so it will be so she should be finishing off it in 2:45, 2:45. She'll be finishing it off. And the last session we'll have it at 3:30. Okay. Okay.
So you will have to log out.
Yes, sir.
You have to leave the meeting, or
No, you need not leave the meeting. I'm not closing the meeting. I'm just stopping the recording, and that's it. I think.
Okay, sir.
I'll pause the recording. I'll pause the recording. We can meet at 1 o'clock. Okay. So thank you. Bye.
Price call option is exercised. Call option is not exercised. Is it conceptually clear to everyone, or any questions anywhere? Is it okay? Can we proceed further?
Perfect, ma'am. Perfect.
Pardon, ma'am?
Perfect, ma'am. You continue, please.
Yeah. Now, next one is, so in this process, what I'm trying to do is, here, there are 2 parties. Here, I attributed it to myself. Actually, there are 2 parties for either call option or put option. I'm starting with call option first. Then we will proceed with put option as well. So in options, there are 2 things, call option and put option. So when it is call option and put option, first for the time being, I'm talking about only call option. For call option, there are 2 parties. In this above example, I have bought initially what? Did I buy the asset or did I buy the option? In first case, in my example, today, what did I do? I simply bought the asset or I bought the call option. Which one did I do? Did I decide whether to buy the asset or not today itself, or am I going to decide after a month?
Today I have bought call option.
Today we have bought only call option. Whether to buy it or not, I will decide after a month. So what is my role here? Buyer of the call option. I acted as the call option buyer. But who is the counterparty with whom I have entered into the contract to buy the call option? That person is said to be call option seller. Am I clear? That person is said to be call option seller. So whether you call it as call option seller, he is also called writer also. Whether you call it as a writer or seller, both are same. Both are same. Now, if it comes now, next thing is that here buyer of the option, call option buyer, has the right of what? Right to
On it. Weakest. Yeah, weakest.
right to buy what? Underlying asset.
Camera.
Hello. Right to buy underlying asset. What is the underlying asset in our example? House. At what price?
1 crore.
That is strike price.
Strike price.
At strike price. Right to buy underlying asset at strike price when after a month. That is on pre-specified future date. Am I correct? Pre-specified or predetermined future date. So buyer of the call option has right to buy underlying asset at strike price on predetermined future date. So whenever he person has the right, in order to acquire that right, what he is doing? He pays premium amount. That is nothing but call price. What is he doing here? He pays premium amount, that is call price. In our example, how much is that amount? 10,000 rupees. What is the role of the call option seller now? What is the role of the call option seller here? What he will do? Does he receive the premium? Did I pay 10,000 rupees to my counterparty? It means to say he receives premium. When he receives premium, you tell me, what is his role here? Does he, whenever first party has the right, what is the role that second party writer or the seller of the call option will have? If I say that I want to buy the house for 1 crore rupees, does he require to say yes or not? Because he has already taken 10,000 rupees price for the option. So does he require to say yes or not? Seller.
It's an obligation.
If I say I want to buy, seller has to say yes. If I say I don't want to buy, seller has to say no.
Yes.
So as you rightly said, it is an obligation. Sell what? An obligation to sell what? Is it option or underlying asset? Obligation to sell?
The underlying asset at the strike price.
Underlying asset at strike price on predetermined or specified future date when he has to sell if call option buyer demands. If he says he wants to buy, he has to sell it. I mean to say, if the call option buyer wants to buy, this is what is the role of these two people. So I want to make it clear in the very beginning. Some of you must be, as I understood from the profile as given by Rakesh sir, most of you must be traders and you must have written books on derivatives. Maybe first few, maybe another 10 to 15 minutes, it must be boring for you. Sorry for that, because we have diversified group of people. So to address them, I'm just going as such. So now you tell me, role of the call option buyer when it comes to call option, what is his role? When it comes to option, did he buy the option? Yes. A seller sold the option. But when it comes to underlying asset, what is the role of the buyer of the call option? Is he going to buy in future or is he going to sell in future?
Buy in future.
Underlying asset, buying, call option seller, selling. Up to this extent, we have understood. So now what we'll do is, we will try to understand it by looking at NSE website. And can you see my screen, an NSE screen?
No, ma'am. Till now.
No, ma'am.
You are not able to see. I think I need to share this separately. Can you see now?
Yes, ma'am. Yes, ma'am.
Yes. Now just let us look at NSE website here. Here I'm trying to look at September expiry option contracts. On September 30th, 2021, if you see expiry date, today is 15th September. What is the market price of Nifty, underlying price of Nifty? Here I'm attributing Nifty 50 to similar example that we have taken to house, underlying asset. So Nifty 50 current market price is how much? At around 1244 latest update price. I mean, as per my screen, how much is the current market price of Nifty 50? 17,000.
17,475.
475. Here, whatever agreed upon price of 1 crore rupees we discussed till now, there won't be one agreed upon price. There won't be one strike price. There can be n number of strike prices as decided by strike price scheme of NSE. So you can see strike price starting from 10,500 and ending with, say, 18,900. So we have number of strike prices at a particular point of time for trading. Okay, let us say what I'm trying to do is current market price is 17,475. So I'm trying to look for this strike price which is close to current market price. That is, say, 17,450 or 17,500. Any of these two prices are close to current market price. Okay, and the next thing that I want to show you is on the left hand side you can see calls, on the right hand side you can see the name put, and on the left hand side you can see bid price and ask price, left to bid price, bid quantity, ask price, right to ask price, ask quantity. Similarly you can see the screen even for put option, but as of now, since we are discussing only for call option, we start with that. So in call option, when I'm trying to look for closest strike price to the current market price, let us take it as 17,450 somewhere. If you see this time, what is the bid price of call option and ask price of call option respectively at 17,450 strike price? Approximately how much is it? Can you see here? Bid is 164.
164, ma'am.
Bid is 164 and ask is
164.2.
0.2. So it represents what? Approximately close by prices of call option is they have given last traded price. Last traded price means just before maybe the recent trade that took place, that at 164.25 rupees. So I'm taking this price approximately 160 rupees. You take 160 or 170 just for our understanding purpose. So here, what is strike price here? 17,450. What is call price here? Around 164. I'm taking these figures into my Excel sheet. I'm trying to do analysis here. So what I'm doing here is I'm taking Nifty 50 call price, Nifty 50 call option I'm looking at. As of now, which position I'm saying that
Screen share.
I think screen has to be shared every time I change this. 1 second, ma'am. I'll just share you. Is it visible now? 1 second.
No, ma'am, till now.
No, ma'am.
Ma'am, the last trading prices with the premium.
Yes, sir. Premium only. It is price of the option. It is not the price of the underlying asset. Got it?
Right.
We are mainly dealing premium means option price we are talking about.
Right.
So can you see my Excel sheet?
Yes, ma'am.
Yes, sir. Now Nifty 50 current I'm taking strike price of 17,450. How much strike price I'm taking? 17,450. So strike price is 17,450. What is call premium? Call premium is, that is call price. Call price or call premium is 162 somewhere. So I'm taking approximately price around round figure, close by round figure. I'm taking 160. Is it okay? So expiry is what? What is the expiry date?
13th September.
Expiry is 30th September. So that is last Thursday of September. So September 30, 2021. So this is what it is. So what I'm trying to do first is I'm talking about buyer of call option role first. Buyer of call option. What is the buyer of call option here? In this terminology, buyer we technically call it as long position. If you sell something, we call it as seller as the short position. You must be aware of it. So in this terminology, long means buying, short means selling. So instead of saying every time buyer of call option, I'll simply say long call position holder. Long call position holder means whenever I buy the call option, it is said that I have taken long position in call option. Long position in call option. So I am talking from the viewpoint of the buyer of the call option. So how much price he has paid to buy the call option here? How much price he has paid to buy the call option? 160 rupees. Okay. All of you, are you aware of what is that called lot size? Lot size idea? Any idea about lot size?
Yes, ma'am.
Then we will proceed further. Now we will see here, that is, let us say I'm just giving different dates. Say on September 30th, that is on expiry. I'm talking about September 30th, 2020. On September 20th, 2020, if spot price of Nifty 50, spot price of Nifty 50 on that particular day, let us say, if it happens to be, say, 17,000, if it happens to be 17,000, let us assume you are the buyer of call option. If you are the buyer of call option, and if that price happens to be 17,000, you tell me, and your agreed upon price is how much? You bought the call option by paying 160 rupees at what price you promised? 17,450. Now you tell me, if agreed upon price is 17,450, will you be ready to buy Nifty 50 as per call option agreement at 17,450, whereas the same Nifty is available in the market at just 17,000? Will you be exercise the call option?
No.
No, ma'am.
So call exercised? No. No. So I'm taking different price ranges, 17,000, say 50, 17,100. I'm just taking different price ranges. So we will try to, if price of Nifty 50 happens to be so, how we behave, that is what we are trying to understand. So no. So in second case, will you say if at all price happens to be 17,050?
No.
No. Till when you will say no?
Till 7,450.
Till 7,450. If price happens to be 17,500, will you say yes or no?
Yes, ma'am.
Yes. Why? Because that particular day, if price is 17,500, you are paying only 17,450 to buy the underlying asset. That is Nifty 50. So because of that reason, you are okay to pay 17,450 when market price is greater than that. So finally, what we concluded from all these things, we say yes. Now you tell me, what is the amount at gross level? If you say no, what you are losing here at gross level? I'm not talking about net level. If at all you say no, what was our gross payoff? It is you are losing nothing. Are you losing anything by saying no? No, because you want to avoid some unfavorable situation for you, because you don't want to pay 17,450 to buy asset worth of just 17,000. So simply you are saying no at gross level. But at net level, what is your payoff?
160, ma'am.
Minus 160, because you have paid premium to buy that right. So that is minus 160. Let us see, till as long as you say no, what is your gross payoff? Gross payoff is 0. Gross payoff is 0. But once, now let us see here. Now just tell me, if market price happens to be 17,500, you said that you will say yes. Why do you say yes? The price at which you are buying Nifty 50 is how much? 17,450. But the actual price of Nifty 50 in the market is 17,500. It is similar to the market price of the house is 1.2 crore, but I am spending only 1 crore to buy that house. So definitely I will be enjoying profit. How much profit I am enjoying here? How much profit? 50 rupees. In second case?
100, ma'am. 100.
100. In third case? 150. 150 as such. Okay, I'm just taking an example. We will further proceed. Now you tell me, if you keep on doing this way, I'm simply putting in the form of equation market price, spot price minus Spot price minus what? Strike price.
Strike
Spot
price.
price minus strike price. So that I can easily relate it with. So spot price on maturity minus strike price. Okay, this way I'm getting the payoff. But now I'm just trying to understand. Can you see any negative payoff here? Gross level mein, I'm not talking about net level. Gross level mein, can you see any negative payoff, or will you see only?
No, ma'am.
You will see only 0 or some positive payoff. I know. So you are able to see only 0 or some positive payoff. The positive payoff is equivalent to how much? Positive payoff is equivalent to how much?
Minus strike.
Strike price, spot price minus strike price. Spot price on maturity, that is why I'm calling ST. ST is nothing but spot price on maturity as strike price. Either I can see 0 or I can see spot price on maturity minus strike price. So out of these two, which value I am seeing? Am I seeing maximum value or minimum value? Am I seeing maximum value or minimum value?
Maximum value, ma'am.
Maximum.
I am able to see maximum value. So can I say that if someone asks me what is the payoff for long call position, can I say that maximum of ST minus K comma 0? Long call payoff. What is the payoff for long call position? Maximum of ST minus K comma 0. Can I conclude it as such? Any questions anywhere? Any questions? Should I repeat it? Okay, fine. Now let us see now. Just can you see my word file now? I think every time I'm changing the screen, it is getting stopped. I'll do this. Yeah, can you see my word file now?
Yes.
See, I'm just taking few setup prices, not many as I'm showing in Excel sheet. I'll just take it into the code file just to look at. I hope my screen word file is visible.
Yes, ma'am.
Yeah.
Yes.
Here what I'm trying to do, whatever we have done in Excel sheet, I'm bringing it back and I'm showing it to you. This first column is what? Spot price on last Thursday of September, that is on maturity. Call option is exercised or not, that we are taking. This we are talking in terms of gross payoff. So whenever gross payoff, how is it happening? I have introduced a small formula now. In that formula, what is happening is, in first case, you see, if I'm taking the formula maximum of ST minus K comma 0, something like that. Yeah. See, now you see maximum of ST minus K comma 0. This is what I'm taking. Now you tell me if spot price is 17,000. Tell me if spot price is 17,000. If you substitute the value in this equation, how much is 17,300? Strike price is how much? How much is the strike price we decided? 17,000?
17,450.
17,450. 17,450 comma 0. Out of these two, maximum value is how much? Maximum value is how much out of these two? Maximum of 17,300 minus 17,450. How much is the value here? Minus 150 comma 0. Out of these two, maximum value is how much?
0.
0. So same 0 did we get here as the gross payoff? Did we get here same 0 as the did I introduce this gross payoff here as 0? Now let us come to 17,500. In case of 17,500, if I introduce the same equation, okay, how much is the maximum value? Maximum value is how much? ST is how much here? When the market price on maturity is 17,500, how much is ST here?
50 and 0.
17,500 minus strike price is how much?
17,450.
17,450. So how much is the value here?
0, 50 and 0.
Maximum of these two. Maximum of these two. 50 comma 0. Out of these two, maximum is how much? Maximum of 50 comma 0. Out of these two, maximum is how much?
50.
So is it, did I get 50 as output here?
Yes, ma'am.
So are you clear about the long call payoff now? Is it clear how long call payoff is derived? So if there is anything like what is the payoff for long call position, what do we need to say? Spot price minus strike price are 0. Maximum of these two values will be call option, long position, payoff. Similarly, you can experiment with the next example. Maximum of 17,550 minus 17,350. How much is the payoff here? Maximum of these two is how much? 100 comma 0. Maximum of these two is how much? Maximum of these two is how much?
100.
100. So, is there any question or query about payoff, or is it okay? Can
Okay,
I
ma'am.
is it clear to everyone how
Yes,
payoff
ma'am.
for
Yes,
long call
ma'am.
position is derived? So
Yes,
finally,
ma'am.
what we
Yes,
understood payoff for long call is maximum of S minus K comma 0. Now, if it is clear up to this extent, what I'm trying to do is I'm just putting for short call position. For this, gross payoff is that one. What is net payoff? How do we understand net payoff? Simply,
Less the premium.
net payoff is,
Premium.
Deduct the premium.
yeah. So how much is it now? Net payoff, how much is it now? In first case, how much premium did we pay? 160? So minus 160 because gross payoff is 0. So up to this extent, it is minus 160. Minus 160. Minus 160. But here, how much is my gross payoff? Net payoff?
110.
Minus 110.
Minus
Next.
110.
Next, how much is it? Minus?
Minus 10. Minus 10.
If this is 100,
Minus 60.
my payment
Minus
is
60.
160. How much?
Minus 60.
Minus 60. After that?
10
Minus
Minus
10.
10.
Minus 10. Next one?
plus 40.
Plus 40. Okay, as such, we keep on deriving. As such, we keep on deriving. Now, I'm taking you back to Excel. I'm taking you back to Excel. In Excel sheet, we will work the same thing again so that we will try to see the payoff and everything. So what I'm doing is here for deciding gross payoff, I'm simply using the equation instead of doing it manually. Maximum of
And we cannot see the Excel sheet.
Yes, ma'am. Every time I'm changing, I think it's not getting, I'm showing you. Can you see now?
Yes, ma'am.
Yes. Now you see, I'm putting in the form of equation instead of breaking our head. Maximum of spot price is here. In as per my Excel sheet, it is C9 minus strike price is 17,450 or 0. Maximum of these two. So C is fixed. This is what strike price we already decided. So I'm just simply dragging this cell. So this entire thing is captured in my equation. Up to this extent I have done. Next step, how much premium I have paid? 160. So my net payoff is how much? This gross payoff minus whatever premium I have paid. Gross payoff minus whatever premium I have paid. That is net payoff. So whenever I got this net payoff, what should I understand from this? We need to interpret these payoffs once. First, let us start with this. When the prices are low, am I in profit zone or loss zone? When prices are low, am I in profit zone or loss zone?
Loss zone.
Loss zone. When the profits are an upside, when profits, I mean to say market price and maturity is higher side, am I into profit zone or loss zone?
Profit.
I'm into profit zone. First thing is that I am into loss zone when the market is in downtrend, and I am into profit zone when the market is in uptrend. That is first point. From this, what do we understand? Who will go for buying the call option? Is it the person who has the viewpoint of bullish market, or is it the person who has the viewpoint of bearish market? Who will buy call option? Viewpoint of long call market is bullish. Which bullish? If the price goes up significantly, are you able to enjoy maximum profit or not? Maximum possible. If price goes up to 19,100, is your profit going on increasing or not? Yes. So as a result, what we can say is our viewpoint is if the market is significantly bullish, we say that we are enjoying profit. So the long position viewpoint is what? Long call position viewpoint, significantly bullish viewpoint. It means to say, if you feel that the market goes up in future, you will go for long position in call option. That is one point. And second point, what I want to show is same thing I want to show in the form of a chart also, so that we can do interpretation both the ways. So let us say we are taking a chart here. On x-axis, I'm taking spot price and maturity. On x-axis, what I'm taking? Spot price and maturity. And y-axis, this is long call position. On x-axis, I'm taking spot price and maturity. And on y-axis, I'm taking net payoff. On y-axis, I'm taking net payoff. So if you take this way, how is the graph looking like? How is it looking like? Up to a certain extent, it is straight line. After that, it is upward sloping. Am I correct or not? In other way, we can interpret it is that when the price is at lower level, you are into loss zone. When the price is increasing, you are into profit zone. That is one point. So from this, we have written that we have bullish viewpoint. Second thing, what is your maximum loss here? What is your maximum loss? 160. 160 is nothing but the premium amount that you paid. Is it correct? How much is the cost of the strategy? How much is the cost that you paid for buying the call option? 160. So the premium amount that you paid is maximum loss. How much is the maximum profit? Is there any limit for the maximum profit? By looking at this diagram, you can say, is there any limit? No. No. So first point that I want to write here is that so first point, viewpoint is significantly bullish viewpoint, and second point is maximum gain is unlimited. Maximum loss is limited to what? Maximum loss is limited to what?
Premium.
Call premium. Premium. Now you tell me, where is the breaking even? Where is the break-even point? Look at how much is the break-even point? When price is 17,600, he is lost into loss of -10. When price is 17,650, he is into profit of 40. So where is the break-even point here?
രാവിലെ മിക്കവാറും സാരി ഉപ്പ് കഴിയുമ്പോൾ എനിക്ക് ഒന്നുകൂടെ വാട്ടം
Where is the break-even point?
ഞാൻ സൈക്കിൾ മാറിയിട്ടാ
In between the
How much
650
it can
and
be?
600.
How much it can be?
അപ്പൊ ഞാൻ ഒന്നുകൂടെ
17,610. I know 17,610. So how do we decide the break-even point here? 17,610 means how do we generalize it? What is the strike price? 17,450. And break-even point is 17,610. How do we derive this break-even point now quickly? Is it not equivalent to strike price plus premium? Strike price is 17,450 and premium is 160. So how much is the total price? 17,610. Can I say that break-even point for long call position is 17,610? That is nothing but strike price plus cost of the option. I mean to say option price. Strike price plus option price. Call premium. Is there any question here? Is it okay? Clear?
Okay, ma'am.
Is it okay or any further clarification required? Cost of plus premium. Fine. So this is one thing that we understood about call option. So we will try to summarize whatever we learned about the call option. So
Ma'am, please explain about break-even point. What will be break-even point?
okay.
അതിനെ കാണാതെ മറഞ്ഞിരുന്നതിനെ
Can you see
Please,
my
Philomena,
screen?
please mute.
അവളെ
Philomena,
കൊണ്ടാന്ന് പറഞ്ഞെങ്കിൽ ഇതില് മാറുക
Philomena, please mute.
പിന്നെ ഞാൻ പറഞ്ഞു പിന്നെ എപ്പോഴും ഡയപ്പർ എടുക്കും.
Yeah. Now, what is the strike price at which you have taken position? 17,450. And how much? Somewhere some disturbance. Can someone? Is it possible to mute?
Ma'am,
only host can mute them, ma'am.
Yes, that is the problem here.
Ma'am, you can mute.
No, I am not the host, sir, so I cannot.
Rakesh sir, if he is available, then he can mute it now.
Yeah. Now call premium is 160. So how much is the value if you sum up those two? You are paying 160 rupees to buy the call option, and you may have to pay 17,450 to buy the underlying asset. Total cost incurred for you is how much? 17,610. So where will we be breaking even? At that level only. If the spot price and maturity is 17,610, you will be breaking even. That is why break-even point is, so your net payoff is 0. Break-even point is nothing but wherever your net payoff is 0, that is break-even point. Okay. So if you have to generalize the break-even point for long call position, we simply say strike price plus call premium. Is it okay? Is it clear?
Yes.
Yeah.
Yes,
now we will try to understand one by one about call option. What is the summary that we can draw from call option long position? What did we understand long call position say? First point is, when do we go for long position in call option? Whenever we have bullish viewpoint, first point. And what is the maximum gain that we may enjoy in call option?
Unlimited.
Maximum loss is limited to just
Call premium.
premium. And what is the break-even point here?
Strike price plus call
Premium.
What is the payoff for a call option? Long call position payoff is what? Long call position payoff is what? Maximum of
premium.
Strike price minus spot price minus strike price.
Spot price minus strike price are 0. Out of these two, maximum value. Now you tell me buyer of the long call position. Here that we will come little later. So its payoff diagram looks like this, indicating unlimited gains and limited losses. Okay, if short call is clear, then we proceed with long call is clear, we will proceed with short call position. See, let us see if till now we have seen from the buyer point of view. Up to this extent, we have seen from the buyer point of view. This payoff is applicable for long call position. But who is the counterparty for this long call position holder? The person whoever is sold the call option, because for call option there are two parties, buyer and seller. So for buyer of the call option, we will try to see. Seller of the call option we see now. Seller of the call option, we call it as he has taken short call position. Short call position, what is his role? His role is obligation to sell underlying Nifty if buyer wants to buy. Okay, so he has an obligation. Now you tell me, in first case, is buyer saying yes or no? Is buyer saying yes or no? To say yes or no is in the hands of the buyer, because buyer has got the option. So seller has an obligation. He has to say yes, whatever for buyer says. Now you tell me, for short call position, what would be the gross payoff if at all buyer says no, I don't want to buy? That is what he said. Then what will be the payoff here? If it is 0 for the buyer, for him also it is 0. Okay, understand one important point. As long as buyer says no, it is celebrating time for the seller. Why? Buyer says no when things are unfavorable to him but favorable to the seller. So here buyer says no means his payoff is also 0. But how much is net payoff for the seller? How much will be the net payoff? In the beginning, how much did he receive? 160. 160. So his net payoff is positive 160. His net payoff is positive value of 160. So from this, what we understand here, whenever buyer says no, for the seller of the option, short call position holder, gross payoff is 0, net payoff is equivalent to premium that he received. So in second case, again, how much is it? 0, 160. So as long as the first person says no, it is 0 only. Now let us say, the moment first party says yes, how do you understand? How do you interpret the situation? Carefully follow. The buyer of the call option is saying yes. What does it mean? Why does he say yes? Why is
Market
he saying?
price has risen.
Because he is able to buy the asset, the value of which is in the market 17,500, but for only 17,450. He is able to buy just for 17,450. If you see from long position point of view, he is paying less price than what it deserves for. So that 50 rupees is gained for the short long call position holder. But if you see from short call position holder, what is the payoff from the short call position holder point of view? You try to see what is that he is doing. He sells. He sells what at price? At 17,450. He sells at 17,450, but the value of which is how much? 17,500. So is he selling at the lower price than he deserves for?
Yes.
When he sells at the lower price than he deserves for, how much loss he is incurring?
50, ma'am.
Minus 50. So I hope logic is clear. In second case, the seller of the call option has an obligation to sell at 17,450, even if the price of that asset in the market is 17,500.
Minus 50 is the gross.
Yes, sir, it is gross. Yes, sir, it is gross. We will discuss net. We will discuss net. So here minus 50 is at gross level. But at net level, how much is it?
160 minus 50.
So 110. It is 110. So in second case, how much is the loss for the second party now? He is selling the asset worth of 17,550 just for 17,450. How much is the loss? Minus 100. So net loss is minus 50 as such. So now you tell me.
Ma'am, minus 60.
Yes, sorry. Minus 60. Yeah. Now you tell me one important thing. Instead of writing this such a big table, if I want to summarize into a small equation, how do I summarize the 0 minus 50? How do I summarize it? If you carefully look at how is the payoff, as long as long position is 0, short position is also 0. Whenever long position is positive, what is happening to short position?
Short position decreasing, ma'am.
It is negative, hai na? By the same amount, short position is negative. Am I correct or not? By the
Correct.
same amount, short position is negative. You come to third level, it is minus 150. So what do I understand from this? Payoff of short position is just a mirror image of payoff of long position. Can I say like that? Payoff of short position is mirror image of payoff of long position. Is it okay? Is my explanation okay? Any question anywhere? If it is minus for him, it is plus for him and vice versa. At grass level, I'm talking about grass level as of now. Any questions anywhere? Can I proceed? Yeah.
Yes,
now,
ma'am.
if it is the case, you carefully see, for long position holder, I have written equation of maximum of ST minus K comma 0. But for this person, how do I write the equation now? Is it not simply minus maximum of ST minus K comma 0? Whatever payoff the first person is getting, for that payoff, if I simply put minus before, am I able to derive this person payoff or not? If it is minus plus 50 for him, it is minus 50 for him. Am I correct or not?
Yes, ma'am.
If this, whenever I say minus maximum of ST minus K comma 0, can I write it this way? Minimum of K minus ST comma 0. Can I write it this way? Instead of writing minus ST minus K comma 0, can I write it as minimum of K minus ST comma 0?
Yes, ma'am.
Yeah. So finally, what we understood, what is the payoff for short call position? Payoff for short call position is minimum of payoff for short call position is minimum of K minus ST comma 0. Minimum of K minus ST comma 0. That is payoff for short call position. So I'm writing the same thing so that we can generalize the equation. Minimum of K. K is how much? 17,450 minus ST comma 0. So how much is the net payoff? Net payoff is gross payoff. What should I write here? Did he receive the premium or did he pay the premium? Did he
receive the premium?
Since he received the premium, what can I write? G9 plus C4. Premium amount is received. Now you tell me, how does his payoff diagram look like? Whenever market is in downtrend, he is into profit zone. But whenever market is into uptrend, what is happening to his profit?
Loss.
He is into loss zone. So we will start interpreting that one by one. He is into loss zone. Okay. So first thing is that whenever market is in downtrend, he is into profit zone. So what is his viewpoint? Who goes for short position in call option? Short
Has got a bearish outlook.
So short call viewpoint is what? First point. Is he getting maximum profit even if the market comes down significantly, or is his profit limited only?
Limited, ma'am.
It is profit is limited. So currently, from current level, even if market comes down little bit, he will be able to enjoy maximum possible profit of 160. Even if it comes down significantly, I don't think there is no way that he will enjoy maximum profit. So we can say that his viewpoint is moderately bearish. His viewpoint is moderately bearish. What next? What is his maximum gain? Is it limited or unlimited? How much is it? Limited to what? Limited to premium received. Limited to call premium received. What about his maximum loss? If
Unlimited.
the market is unlimited if the market goes down. So unlimited. Unlimited. What is his break-even point? His break-even point is also
Same, ma'am.
same as long position. That is 17,000. But what is the difference between long position and this position holder at break-even point? It is strike plus long, call premium. But what is the difference? How does his payoff diagram look like? Can you please compare with the above diagram and tell me? Can you describe how it can look like?
Ma'am, bearish.
Bearish means it looks similar to what? Can I say it is a mirror image of this one? Whatever
Yes,
we
ma'am.
are seeing. So
Yes, ma'am.
when the market is in downtrend, he will be above the x-axis. He will be above the x-axis. When the market goes up, he will come towards below the x-axis. So because of that, in short call position, another important thing we need to write payoff. His payoff is minimum of K minus ST comma 0. And if you see the same thing in the form of a diagram, I'm showing in chart so that we see whether it is looking like mirror image of the first one or not. So on x-axis, I'm taking once again, I'm doing it for short call position. On x-axis, I'm taking spot price and maturity. On y-axis, I'm taking net payoff. Now you check it, how is it looking like? When is it? Market is in downtrend, he is into loss zone. When the market is in uptrend, he is into profit zone. This is just a mirror image of what we have seen earlier. So this is about short call position. I hope it is okay between how we are able to differentiate between long call and short call. Is it clear? Can I proceed further?
Yes.
Yeah. Yeah. Any questions anywhere, ma'am? I can hear something, some question from someone. It is long call. It is short call positions. Can I proceed now? Now let us look at put option. What will happen in put option? Here, in case of put option, let us say you bought a put option. I'll just show in Excel Word file first. In case of put option, yeah. Let us say I'm taking a small example. X bought a put option on Nifty 50 at the strike price of 17,450, same amount I'm taking as we have taken earlier. At the strike price of 750 for September expiry by paying premium of, how much is the put premium? We will look at on NSE website now. Just let us go to NSE website. Can you, one second. Can you see this site and see what is the price of the put option at 17,450?
No, ma'am.
You can
It's
see
not
now.
visible.
Now it is visible.
Yes, yes, ma'am.
Yes.
17,450. Right side you can see put price. Left side you can see call price. Right side, what is the last traded price? Around 154.
154.
Around 150. So for the sake of my convenience, I'm making it as 150 just to understand the concept only. So 150 I'm taking. If I'm taking 150, now I'm shifting to Word file. So by paying how much? I am doing it by paying Is my screen visible now better?
Yes, ma'am.
Yeah. So is it okay, ma'am? Now is it clearly visible or should I further zoom it?
No, ma'am, clear, ma'am.
Yes, clear, ma'am. It is. We have decided how much price we will take. Somewhere around 150 we decided. Am I right? Right? Yeah. Now you tell me, let us say on maturity, that is on last Thursday of September. Okay, on maturity, let us say if market price happens to be 17,000, say 300. If on maturity, spot price happens to be 17,400 for 300. Tell me, in put option, what is your role here? X bought a put option on Nifty 50 at the strike price of 17,450 for September expiry by paying premium of 150 from Y. So X role is what here? Y role is what here? X role is put option buyer. And Y role is put option seller. So buyer of the put option I'm technically calling long put position. Seller of the put option I'm technically calling short put position. Now you tell me, carefully understand, in put option what right do we have? Right to buy or right to sell? That is the thing that we need to understand. Put option gives right to sell. If it is the case, what we understand from this particular statement is that X has bought a put option from Y